Hi, everyone. Welcome to today's conference. I'm Dennis Kelleher, President and CEO of Better Markets, which I co-founded in 2010 with Michael Masters, who you will be hearing from later in the program. Better Markets is a nonprofit advocacy organization based in Washington, D.C. Using its unique arc of advocacy, it fights for the economic security, opportunity, and prosperity of the American people in the legislative, regulatory, and judicial arenas. Its overriding goal is to ensure that our financial and economic systems serve all Americans, the productive economy, and society at large. It's our pleasure to be co-sponsoring this event with the George Washington Law School, who we have partnered with several times over the last decade. Before I introduce George Washington Law's interim dean, I want to thank the entire Better Markets team for all their incredible work over many months in making this event possible, especially our Director of Administration, Natalie Schatz, who has made virtually all of it possible. And now I'm pleased to introduce Christopher Bracey, who's the interim dean at George Washington Law and also the vice provost for faculty affairs of George Washington University, where he supports faculty members at all 10 schools across the university. A professor of law at George Washington since 2008, Christopher is an internationally recognized expert in the fields of race relations, individual rights, and criminal procedure. He's the graduate of my alma mater, Harvard Law School, where he served as supervising editor of the Harvard Law Review. His highly regarded service as interim dean over the last year will conclude soon, but we're delighted he's here with us today. And ladies and gentlemen, please welcome Dean Bracey.
Thank you for that introduction, Dennis. On behalf of GW Law and the Business and Finance program, we are pleased to co-sponsor today's program with the Better Markets. I welcome you to this important and timely conference to commemorate the 10th anniversary of President Obama's signing of the historic Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010. I would like to extend a special welcome to the many GW Law alumni joining us from around the country and the world who work in all parts of finance, financial regulation and government, and business. I also extend a warm welcome to the GW Law students in the audience who are also persevering through the many challenges of the current health and economic crisis and who will no doubt be among those fighting on the front lines of the next financial crisis. Today's program features a great lineup of speakers who will provide their unique perspective on the Dodd-Frank Act, financial reform, the economy, and related issues, past, present, and future. We are privileged to be grateful to be able to kick off this commemorative conference with welcoming remarks by former President Barack Obama, who signed the Dodd-Frank legislation 10 years ago today. We can't thank him enough for joining us this afternoon. Later in the program, we will hear from the namesakes and key architects of the landmark legislation themselves, former Senator Chris Dodd and former Representative Barney Frank, whose keynote discussions will be moderated by Stephanie Ruhle, NBC News senior business correspondent and anchor of MSNBC Live with Stephanie Ruhle. Senator Elizabeth Warren, one of the most powerful progressive voices in America today, will deliver the closing keynote. Most recently, one of the major candidates for the 2020 Democratic presidential nomination, Senator Warren was intimately involved in the development of key elements of this institutional response to the 2008 financial crisis, including the creation of the Consumer Financial Protection Bureau, and is currently a senior member of the Senate Banking Committee. Rounding out this program will be 20th century banking giant John Reed, who will reflect on 50 years of banking and finance. Financial regulation veteran Sheila Bair, who played a central role during and after the financial crisis as chair of the Federal Deposit Insurance Commission. Sarah Bloom Raskin, a former governor of the Federal Reserve Board and former Deputy Secretary of the Treasury. And Representative Maxine Waters, sitting chairwoman of the House Financial Services Committee, who will provide us with an insider's view from the House. With so much going on in today's world, it may be difficult to remember the dire economic crisis facing our nation in 2008 following the worst financial crash since 1929. The largest banks in America were collapsing. The financial system was freezing up. Companies across the country were laying off workers, and many were closing and going bankrupt. Millions of people lost their jobs, savings, and homes. Young people graduating from college couldn't find jobs. That was the situation President Obama faced as he took the oath of office in January of 2009. In that context, GW Law alums and other lawyers around the country and the world suddenly found themselves playing a key role providing crucial advice and counsel to organizations of all types to help them navigate through these uncharted waters during an extended period of fundamental uncertainty. First, getting through the immediate shock of the depths of the great financial crisis of 2008 and 2009, then developing business and regulatory responses to the crisis in the near-term aftermath, and finally, adapting to the new post-crisis, post-Dodd-Frank world. We believe that this conference, recalling these circumstances, policy objectives, and post-passage implementation of the Dodd-Frank Act underscores the value of GW Law's long history and deep commitment to education in business and finance law. In addition to the specific areas of substantive business and financial law expertise taught here, we pride ourselves on emphasizing three overarching themes. The increased challenge of global financial stability in a complex world, the value of innovative and entrepreneurial approaches to solving legal and policy problems, and the fundamental importance of encouraging lawyers to learn and exercise business leadership and judgment, possessing both the cross-disciplinary skill set and the ethical grounding to be able to identify and advise on the most important business and policy considerations in any particular situation. These themes are alive and well today at GW Law. In the broad and deep expertise of our business and financial law faculty and the range of our business and financial law course offerings, in the intelligence and promise of our JD and LLM students, in the accomplishments of our alums in Washington and in financial centers like New York and around the world, and in events like this one, where we bring to you experts in the field to offer their insights and opinions. I'd like to again thank Dennis Keller and Better Markets and Jeremy Pam, the director of GW Law's Business and Finance Law program, who you will hear from today as well for their partnership on today's program. We have a lot of ground to cover. Thank you again for being here, and I hope you enjoy the program.
Thank you, Dean Bracey. Now let's begin. President Obama was the first Democrat in more than 3 decades to win more than half of the popular vote. And he racked up so many legislative accomplishments that some have compared his first 2 years to the historic first 2 years of President Lyndon Johnson's administration. But when he came to office in January of 2009, as Dean Bracey said, he faced the worst financial and economic conditions of any president since FDR in the 1930s. He then led through 2 brutal years of legislative heavy lifting, including the 18 months of fighting for financial reform, while at the same time trying to prevent the collapse of the financial system and a second Great Depression. That would be pretty significant in and of itself. But of course, he did that while also enacting sweeping healthcare reform and advancing so many other domestic, defense, and foreign policy issues. Having done that, and with the benefit of now more than 10 years of hindsight, let's hear what the president has to say about the Dodd-Frank Act and financial reform.
Hey everybody, it's great to join you as we mark 10 years since I signed into law the Dodd-Frank Wall Street Financial Reform and Consumer Protection Act. When Joe Biden and I came into office in 2009, we were teetering on the brink of a second Great Depression. Banks were collapsing, credit was freezing up, companies were shedding jobs and closing their doors, and millions of Americans were losing their homes, incomes, and retirement savings. A lifetime of hard work was evaporating almost in an instant. So as our administration worked quickly to stop the bleeding and recover from the crisis, we also worked to prevent recklessness on Wall Street from devastating folks on Main Street ever again. And the reform we passed did just that. It prevented another era of too big to fail. It cracked down on irresponsible behavior. And it protected Americans from corrupt, predatory practices with the creation of the Consumer Financial Protection Bureau. As you all know, passing and implementing this law was not easy. We were met every step of the way by entrenched and well-funded opposition who tried to block any reform at all. But we kept at it because taxpayers and investors deserve better. We believed our financial system only works. Our market is only free when there are basic safeguards in place to prevent abuse, check excess, and ensure that it is more profitable to play it by the rules than to game the system. And our reforms worked, providing a sturdier foundation to help our financial system weather a future crisis, helping to unleash the longest string of private sector job creation in American history. Now, in the years since I left office, the same forces that opposed us back then have been doing their best to undermine the law. And while they've had some successes, the core of Wall Street reform remains intact. Our reforms are still promoting financial stability. They're still blocking taxpayer bailouts. They're still protecting consumers and investors. And even with a pandemic that's added a historic level of joblessness and contraction, so far these reforms have helped prevent the crisis from spiraling into a financial crisis too. We can't afford to go back to the days of unchecked recklessness and irresponsibility on Wall Street. We've seen how that plays out. We know we can do better. We've proven it. So I want to end by saying thank you, not just to those who helped make these reforms real, but all those who are still fighting to improve the law where we can and safeguard it for the years and decades ahead. Thanks again, everybody. Have a great conference.
Thank you, President Obama. You'll notice not much has changed. He still has the ability to say a heck of a lot in a few words. However, not everyone remembers or wants to remember many of the key points he just made. For example, he said, quote, passing and implementing this law was not easy, close quote, which could win an award for extreme understatement. And he was certainly right when he said that he and his administration were, quote, met every step of the way by entrenched and well-funded opposition who tried to block any reform at all, close quote. After all, that's why it took 18 arduous months to get the Dodd-Frank Act passed. For the same reasons, that's also why it required the next 6 years of the Obama administration, from 2010 through 2016, to make sure that the law became a reality and protected America's families, taxpayers, consumers, investors, and Main Street businesses. It's difficult today to remember much, if not most, of those struggles. And there are lots of reasons for that. First, needless to say, there's a lot going on today, some of which I'll discuss in a moment. Second, the Great Recession was a searing experience for tens of millions of American families who lost their jobs, savings, homes, and so much more. No one wants to remember those awful events. Third, the financial crash was 12 years ago, and the Dodd-Frank Act was 10 years ago. Many people simply have no actual memory of either event. But there's another very big reason for people not remembering. A fortune has been spent on advertising, lobbying, and campaign contributions to erase the memory and rewrite the history of what happened before the 2008 crash, who was responsible for it, the trillions in bailouts, the damage it caused, and why the Dodd-Frank financial reform law was and remains so important to the American people. That's why today Better Markets is releasing two reports. Think of them as memory aids and a historical counter-narrative to those who would try to substitute self-serving spin for facts. The first report is President Obama, in his own words, making financial reform a reality 2009 to 2016. And the second report is 10 years of Dodd-Frank and financial reform, Obama's successes, Trump's rollbacks, and future challenges. I'll provide a brief overview of those reports in a minute, but first I want to address some of the historic events going on in our country today. As the country faces social upheaval and political unrest as a result of racial inequalities that have gone on for far too long, as well as the economic turmoil from the pandemic, one might ask, is it really important to discuss and reflect on the Dodd-Frank Act, a 10-year-old law? I would say yes, because the Dodd-Frank Act and financial stability, financial reform, and financial rules more broadly can be the means to achieve some of the most important social, political, and economic goals facing the country. Those goals include a strong and stable financial system that reduces inequality and creates economic security, opportunity, and widespread prosperity for all people, supports the productive economy, produces sustained, durable, and broad-based economic growth, and protects investors, consumers, workers, and the environment. Those goals, however, are often undermined by an economic system that does not work for the vast majority of Americans because, among other things, the financial system is too often a wealth extraction mechanism for the few rather than a wealth creation system for the many. This is the result of too many, and certainly not all, but too many in the financial sector using their economic power to buy political power, which they then use throughout the policymaking process to protect and increase their economic power, usually at the expense of everyone else, including their competitors and others in the financial sector itself. Making all of that worse, the pandemic and the economic crisis it has caused have exposed the structural inequalities embedded in our economic and financial systems and how they egregiously and disproportionately impact Black Americans and people of color. The financial system and the financial industry have played a significant role in creating and perpetuating those racial inequalities. If Black lives matter, and they do, then we need economic and financial systems that truly work for everyone and lift everyone up. It's critical to remember that the economy, who it works for and who it does not, is not predetermined. It is shaped by people, and it is often rigged by those seeking to protect their own interest. Their actions to maximize their profits, protect and increase their wealth, and maintain their positions of privilege, power, and influence profoundly impact who gets the benefits of our economic and financial systems and who does not. The Dodd-Frank Act could not have addressed and did not address all of those issues, but it was intended to create and support guardrails, gatekeepers, and guard dogs that could force the financial sector to better serve society. That means supporting the real productive economy that generates jobs and broad-based economic growth, rather than enriching the few, destabilizing the financial system, draining public resources for bailouts, and ripping off consumers and investors. That's why what's at stake in the Dodd-Frank law and in financial stability, financial reform, and properly implemented rules more broadly is nothing less than enabling more Americans to attain the American dream and improve their standard of living, quality of life, and peace of mind. That's why the Dodd-Frank Act and financial reform is relevant and important today. That's what President Obama and his team fought for 8 years to achieve, which comes through loud and clear if you go back and read what the president said during that time. It's all in the report that we're producing today, President Obama in his own words. In it, you'll see that just a month after being sworn in, the president laid out his 7 core goals for financial reform, which he then relentlessly pursued. He correctly diagnosed the problem early on. Quote, excess greed, excess compensation, excess risk-taking have made us all vulnerable and left us holding the bag. The business models that created a lot of paper wealth, but not real wealth in this country and have now resulted in a crisis can't be the model for future growth going forward. That's why he said, quote, our goal is to restore markets in which we reward hard work and responsibility and innovation, not recklessness and greed, close quote. He was very clear when he said, quote, we believe in people getting rich based on performance and what they add to the value and products and services that they create, which required building a new foundation for sustained economic growth. Importantly, he also knew that, quote, putting smart regulations in place, oversight, transparency, and accountability, those things are not anti-market. They're pro-market, close quote. And while those rules were unquestionably pro-market, they nonetheless threatened the narrow special interest of Wall Street's biggest firms' ways of doing business, which were incredibly lucrative for them, even as they were dangerous and costly for everyone else in America. To protect their profits and bonuses, those firms decided to ferociously fight financial reform. The opposition was so intense that the president declared in January of 2010 that, quote, if those folks want to fight, it's a fight I'm ready to have, close quote. And they fought and fought until the Dodd-Frank Act was signed into law 10 years ago today. All that fighting has made it easy for those seeking to discredit financial reform to mischaracterize the Dodd-Frank Act as a partisan bill. However, that's simply not true. Yes, it was largely a partisan vote, but it was a bipartisan bill in many of its key substantive provisions. We detail those facts in the second report that Better Markets is releasing today, 10 Years of Dodd-Frank and Financial Reform. That report begins with a history of what led up to the crash, including dangerous deregulation and financialization, and then discusses the major provisions of the law itself, including extensive involvement of congressional Republicans. The report reviews what happened under President Obama and then President Trump, concluding with a look at what comes next for financial reform, including beyond Dodd-Frank. Of course, the financial reform law, like most laws, was not self-executing. Like the financial industry and the financial system, the law was big, complex, and long. It required numerous financial regulatory agencies to consider, propose, finalize, implement, interpret, and ultimately enforce hundreds of rules. Getting that substantially done took the last 6 years of President Obama's administration. The report details that by the end of President Obama's first term, the most dangerous and unreasonable risks in the financial system had been significantly reduced, making a financial crash much less likely due to rules which, in summary, I'm sure you would like me to go over every word of this. I'm not going to. It's all in the report. But the rules lowered capital and liquidity at the banks, increased capital and liquidity, regulated derivatives, required living wills and liquidation authority. President Obama administration also required living wills, liquidation authority, and many other important provisions, including enhancing supervision and regulation of systemically important banks and non-banks. The law also pushed the financial sector more in the direction of serving its socially useful purpose, justifying its social cost, and earning its taxpayer backing by refocusing the largest, most dangerous banks back to traditional banking activities and away from trading and socially useless activities. The point was to get banks back into banking from Main Street. The report also details the deregulatory actions of the Trump administration, which they've begun or completed, urged on by Wall Street's biggest banks and too many in the financial industry more broadly. This also is detailed in the report. I also won't go through this slide. But what's happened in the last 3 years is lowering capital and liquidity, allowing more proprietary trading, rolling back consumer and investor protections, among other things, all of which are detailed in the report, which we hope you will read. Now, the bottom line is, in closing, the report makes clear, as to the events over the last several decades, that it simply cannot reasonably be disputed that strong, robust, and effective markets, free markets, require equally strong, robust, and effective rules that require transparency, oversight, and accountability, establish a level playing field, enable competition, enforce a baseline of fair dealing, police market participants, engender investor and consumer confidence, reduce income and wealth inequality, and ultimately lead to a balanced financial system that fuels the productive economy and improves the standard of living of all Americans. That's why President Obama's work and the Dodd-Frank Act are so incredibly important and relevant today. And that's why we're releasing these two reports, which are available on our website, www.bettermarkets.com, as well as at the microsite for this event. We hope you will read them. Now let's turn to today's program of speakers and hear what they have to say about their role, experiences, and insights in finance, financial reform, and the Dodd-Frank Act itself. I should mention that all the speakers' full biographies are linked in the event website 10yearsdoddfrank.org. Our first speaker is John Reed, a leader in the banking industry who began his career at Citicorp in 1965 and retired as co-chairman of Citigroup in 2000, after which he had several additional prominent roles in finance. That 4 decades plus long career in banking and finance provided him with a front row seat to most of the major events throughout that time. As a recent profile of him began, quote, John Reed is a visionary. His ideas about global banking and transformative technology put him decades ahead of his time and set him apart from his peers as one of the leading bankers of the 1970s, 1980s, and 1990s, close quote. Among other things, he was widely considered a tech pioneer and known as an innovator. I don't know if I agree with the late Paul Volcker when he said in 2009 that, quote, the only thing useful banks have invented in the last 20 years is the ATM, close quote. But I do know John Reed is credited with being a leader in the worldwide use of ATMs, a cutting-edge innovative technology at the time. In 1998, John became co-chairman of Citigroup, when Citicorp merged with Sandy Weill's Travelers Group, de facto taking down one of the most important Main Street protections created after the Great Crash of 1929, the Glass-Steagall Act. He left Citi in 2000, long before the crash. But as everyone knows, Citigroup was at the center of causing and spreading the financial crash of 2008 and required multiple massive taxpayer bailouts to keep it alive. It would otherwise have gone bankrupt and been in the dustbin of corporate history. After the financial crash of 2008, John genuinely and honestly reflected on that crash, what led to it, and what his role might have been in it. As a result, he has candidly admitted being wrong about the benefits of universal banking and about mixing the incompatible cultures of traditional banking with trading and investment activities. He became a vocal supporter of strong financial reform, including testifying in 2010 before Chris Dodd's Senate Banking Committee in support of the Volcker Rule ban on banks' speculative proprietary trading. And in September of 2015, he discussed his broader views about banking and needed banking reforms in a piece in the Financial Times. Without further ado, let's hear John's decades-long unique perspective on the industry and events leading up to and including the 2008 crash and Dodd-Frank.
Thank you very much, Dennis. Thanks for the invitation. And Dean Bracey, thank you very much for including me in this lineup. I'm looking forward to this conference, and I'm glad to be able to help. Mr. President, if you're still watching, I'm delighted that you're here. Senator Dodd, Representative Frank, I'm not sure if you're in the audience. It's somewhat unusual to give a talk simply looking at a screen that has your own picture on it. But in any event, as we think about what's going on in the industry today and we think about the impact of Dodd-Frank, it's sometimes useful, maybe even interesting, to look back and see how it is that the industry has evolved, how it's changed, and what happened that got us where we are today. As was mentioned, I started in the business in the 60s. I joined what was then the First National City Bank, FNCB as we called it. It was a different world and a different business. The focus was very much on customers. Profit was something that we reported at the end of the year. It wasn't something that was focused upon. We did not have a budget when I first joined the bank. There were few metrics. We thought that we needed about 1/8% to put our name on something. So if we lent money or guaranteed something, we figured about 1/8% per month, 1.5% per year was what was needed to pay for the use of our name. Lending was 90 days, fixed rate. Term loans started coming into being during the 1960s, but they were rare. The traditional was 90-day fixed rate loans. We funded ourselves with deposits. If banks didn't have the deposit base, we bought from networks of corresponding banks, typically smaller banks in the center of the country who were long on deposits and would sell them to the so-called money center banks. But this is how we funded ourselves. The only market instrument at the time in the banking industry were certificates of deposit, and they were used, but that was pretty much the only thing. And liquidity was a bond portfolio. We kept a fairly large U.S. government bond portfolio, which cost us a lot of money when Mr. Volcker raised interest rates back in '79. But that was where our liquidity was. It was a bond portfolio, and we thought of capital as being about 10% of assets. The concept of risk assets did not at that time exist. It was simply 10% of your assets. The 70s was a different period. The 70s was a period of interstate banking. The banks that today have nationwide chains were formed at that time. The North Carolina NCNB Bank started out, became the nation's bank, acquired the Bank of America, took on that name, and is today still known as the Bank of America. But it was the North Carolina National Bank, NCNB, that started building that process, that set of branches across the country. Bank One in Columbus, Ohio, the McCall family built up a similar network across the country. They merged with First National, then J.P. Morgan, and they today constitute the backbone of the branch system that J.P. Morgan has. J.P. Morgan Chase, they tend to use Chase for their retail banking and J.P. Morgan for their corporate activities. But this is a period of time. It also is a period of time when banks first went to Washington to try to influence legislation, because the legislation that led up to nationwide banking came out of Washington, and it was the southern banks that started out and first got permission for regional banking and then national banking. At the time, somebody like Citibank, we were contained within the city of New York. We had to fight to get permission to go to Long Island or to Westchester, and it took a long time before the money center banks were allowed to branch across the country. But the 70s was also a period when credit cards came into existence. ATMs, which has been mentioned, first had a broad sort of spread during the 70s. And frankly, it was the first time that banks began to focus on the American consumer as a customer as opposed to simply a source of deposits. The 80s, which came pretty quickly, was focused on cross-border problems. The major banks around the world, not only in the United States, but in Canada and Europe and Japan, the major banks were significantly exposed to developing countries. And of course, the 73 oil crisis led to a disturbance of economies and interest rates. And all of a sudden, in 1982, Mexico suspended payments on their foreign loans, and that kicked off a process that engaged quite a few of the emerging markets. And the banks discovered, myself included, I became chairman in 84, we didn't have the capital to support the risks that we had taken on. We had greater exposure to these countries than our capital would have permitted. This was generally true. And the industry, that is the major banks around the world, were basically bailed out because of the cooperation between the U.S. Federal Reserve and the IMF, led by Jacques de la Rosière at the time. So it was Mr. Volcker, Mr. de la Rosière, who led these two institutions together with the banks to work out this problem. It took the better part of the 80s. If you stuck with it, you got all your money and interest back. You could bail out along the way. Various possibilities for that came into existence, and some banks did. But it was a period of time when we realized that risk was important and our capital was insufficient for the cause. The 90s probably was a more important period, particularly for the purposes today. It was during the 90s that values changed substantially. The stock market had not done particularly well during the 70s and 80s, even going back into the 60s. And the people who had large sums of money invested in the stock markets, particularly pension funds, insurance companies, and so forth, were not earning much of a return. And they were unhappy because in order to provide for their needs, they were having to add money to the reserve so as to have the money to pay pensions or meet life insurance claims or what have you. So there was a lot of pressure on the investors to improve returns. somebody during the 90s got the idea that, gee, wouldn't it be interesting if we bought a little bit of a company and then we went and talked to the management and said, you know what, you're not running this company very well. Why don't you get rid of your inefficiencies, quit playing golf all the time, and let's settle down to business. It was called Greenmail. And it came into being. It hit the private sector broadly. It included banks. It included industrial companies. But there was tremendous pressure from investors to the management of companies saying, we want you to focus on financial returns. And it was successful. It did scare companies into performing better. And it did cause some companies that couldn't perform to merge and to look for ways to provide for their stockholders because they couldn't do so as standalone entities. But it also brought into the value system of the banking industry, but also of the private sector more broadly, this idea of stockholder value. And basically the management was told, look, what we want you to do is to focus on your stockholders, forget all this stuff about your customers, focus on your stockholders. And by the way, we don't care particularly if you focus on the stockholders, you do well for the stockholders. We don't care particularly if you become highly paid. And so all of a sudden, compensation became tied to stockholder return. And to the extent that there had been any general sort of limitations on compensation that just stemmed from the general public, that sort of went away, and management sort of said, hey, we got to focus on stockholder return. Everything became metrics, became numbers, earnings per share, dividends, stock buybacks, so forth and so on, all as a result of this pressure that came from investors. And that is still with us today. That started in the 90s. I watched it happen. I watched the transformation. I remember the chairman of one of my big competitors in New York called and said, John, I'm going to merge with another bank in New York. I said, why are you doing that? He said, look, I've got stockholders who are driving me crazy. I can't respond to them. And so I'm going to merge with this other bank and it'll be good for my stockholders and I'll retire. And he did, in fact, do that. So it became a big change. And I think something that happened in 1995 is indicative of this change. People may remember there was a lawsuit from a big customer of the Bankers Trust Company alleging that their traders had knowingly sold them instruments that would not work out for the customer, but would result in good profits for the bank. Now, in the old days, if you focused on customers, that simply didn't happen. If somebody did that, they would have gotten fired, and it just wasn't part of the culture. It wasn't acceptable. In this case, there were tapes that came out in the court case that indicated that the traders very knowingly had what they called an ROF, a rip-off factor, where they were making money on the back of their customers, and the customers were not getting full value from the services. And this became something that it wasn't limited to Bankers Trust. It wasn't limited to banks alone, but the financial sector began to have the profitability of the sector as being more important than the banks themselves. As this developed and the mathematics of finance developed, Black-Scholes had come into being, and there's a lot of mathematics in finance. You could argue, or at least I used to argue, that basically your traders were trading future probabilities. And so you better understand exactly what the instruments were and what sort of probabilities of payment or lack of payment were built into them. And of course, people sliced and diced, as it was said, and we could provide derivatives and so forth. And markets took over. It started out with mortgage-backed securities. these investors who were looking for returns said to themselves, hey, selves, you could have a package of mortgages, which is a very well-known product and usually pretty good in terms of credit characteristics. And we'll get a package of these, and banks who keep mortgages on their balance sheet have to have reserves against them. And that's, expensive. You got to set money aside against potential losses. We could buy these and we'll cover the potential losses in terms of a diminution of earnings, and we don't have to put money against them. And so pretty soon it became impossible for banks to hold mortgages on their balance sheet, and they became traded instruments. And as I say, once you start trading instruments like this, you could slice and dice and so forth and so on. So this became, during the 90s, a period of fundamental change in terms of values, looking at shareholder return as the dominant value, fundamental change in terms of compensation philosophy. All of a sudden, the industry, which traditionally had not been a high-paying industry, became an extremely high-paying industry, and markets became the cornerstone of much of everything. Now, there was an event at the end of the 90s, after the merger of Citi and Travelers, that should have warned us. Long-term capital. You may recall that long-term capital got into financial difficulties, and it was sort of a precursor of what happened in 07, 08. Basically, extremely complex business that was not understood by the creditors to the company. There was concern as to whether the company was in trouble or not. No one was smart enough to understand exactly what was going on, and so credit froze up, and the Fed came in and organized basically a refinancing for long-term capital and eventually a liquidation. But the point is, this was a precursor from what we encountered in 07. Complexity that couldn't be understood, funding that depends on having some concept of what kind of risks the company you're lending to runs. And of course, complexity makes that difficult. We failed to grasp what had happened there and to learn what might have precluded the problems of 07, 08. The problems of 07, 08 were basically a continuation of that. The industry was deeply involved in trading. When I say the industry, I'm talking about the major banks, the so-called money center banks, the banks that in fact turned out to be too big to fail, too big to be allowed to fail. And these banks were heavily engaged in trading, and it wasn't solely because they were driven for profits. It was because customers, our large corporate customers, American customers, European customers, even some Brazilian customers, I remember, put a lot of pressure on the banks to have the banks take them to market, i.e. to help them finance themselves in the market. We had gotten into the habit of having large syndicated loans with multiple banks providing substantial capital to our customers. And by capital, I don't mean working capital, which traditionally banks have always financed. I was talking about the equivalent of bonds. And these customers wanted the banks to be able to introduce them to the market, allow them to issue securities that people would find attractive to buy, and reduce what they thought their cost of financing might be. And so the banking industry really started getting pushed into the idea of breaking down Glass-Steagall and introducing customers to the market and occupying the space that prior to the breakdown of Glass-Steagall had been reserved for what were called investment banks. And that, in fact, happened. I mean, there was a consensus when We merged with Travelers. It wasn't as if we were the first people to think of this. There already was a political consensus and sort of an intellectual consensus that Glass-Steagall was an antiquated rule and need not describe the world as it then existed. And it didn't, because to the extent that markets were going to play the role that we were talking about, then either you were going to have a much more robust sort of investment banking sector, or you're going to have to allow those of us who had customers who were demanding access to the markets to get into them. The merger with Travelers got us into that business because Travelers had a very strong sort of presence in the markets, but very quickly all of the major banks developed trading activities. Actually, one of the reasons that J.P. Morgan Chase did so well during the crisis of 07-08 was that they had not had a major presence in Wall Street, and it wasn't until they acquired Bear Stearns during that crisis that they had a presence. But most of the other banks were wildly exposed. And we were way out over the skis. There were not management in place. Most of the management of banks were traditional bankers who came out of the customer side of the business. They were culturally totally different than the traders, and they certainly did not understand the complexity of slicing and dicing and derivatives and so forth and so on. And you would have to spend an awful lot of time to go through portfolios to understand, even assuming you knew all the math, to understand exactly what was in a given portfolio. So the industry was out there pressing liquidity to the end, if you will. Liquidity there was 40-to-1 kind of ratios. Capital was not sufficient for the risks that were taken. We had the 07 and 08 problem, and that, of course, brought the system down. Had it not been bailed out by the government, as was indicated before, it most certainly would have collapsed. And the general feeling was that the economy couldn't afford that collapse. And too big to fail became too big to fail. And the industry was bailed out. Lots of explanations as to why. And there were lots of reasons that one might have thought contributed to the problem. But ultimately, it's the management of a company, the board and the management of a company, that's responsible to run a company in such a way as to not get out over your skis where you can't get back in. And so ultimately, you have to assume that the management of these companies and the boards in these companies, the board doesn't have to understand derivatives. Liquidity is dividing one number by another. It's not very difficult to understand. And capital is a number you can put your mind around pretty quickly. And so I have always felt that we, the people who are running these companies, had the responsibility not to get into the position that we did and to therefore require the kind of government bailout. This is where we are. Dodd-Frank came along to correct for the mistakes. It was, as all things are, political. You could argue about was it perfect or not perfect, but it was designed to get away from where we found ourselves. And I think it substantially has done so. As a practitioner, as a banker, I would say that having a living will is an exercise which is well worth going through. Not many managements sit and think about just how would we be able to take this company through a potential bankruptcy or bankruptcy of part of it. And it was something that the management was forced to think about seriously. You couldn't just go out and hire a lawyer and say, hey, would you fill out these forms and send them in to the Fed? The management had to be engaged, as did the board. The stress tests that are now part of the industry clearly are important, and they alert management to what the risks of their business may be, although I assure you that the things that we're stressing for are not the things that are going to be the next problem. You never do. But the fact that you have to think about how are you going to go through a crisis is important. The Volcker rule I felt was very important. Mr. Volcker and I didn't agree on everything, but we certainly agreed on that. And I think there's a fundamental conflict of interest between trading for your own account and trading for customers. And, the banking industry is designed to serve customers. And, I liked it the way it used to be, where profits were what was left over after a good year of working for your customers. And by the way, the business was adequately profitable. Our stockholders were appropriately returned. Wasn't an exciting business, but it was a solid and pretty decent business. So that's sort of my sense of what's happened over the last 40, 50 years in the industry. I think we're better off today than we were during the heydays of 07, 08. But that doesn't mean that the industry isn't taking a lot of risks, and that some of these risks are very difficult to quantify and get your mind around. But I think it's worth thinking how we got here and just saying it wasn't inevitable. There were mistakes made, and hopefully we won't make any in the future. Thanks so much.
Thanks, John, for that sweeping and insightful review of the decades before the 2008 crash and the Dodd-Frank Act. Thinking about customers first and customers only is refreshing and hopefully may ignite some thinking about the appropriate guideposts for the future. That review is the perfect introduction for our next segment. It's now truly an honor to introduce two legislative giants for whom this historic legislation is named, Chris Dodd and Barney Frank. Many things have been said about them, and they've heard most of them, but I'm going to try and say a few things they haven't heard yet in an introduction. Chris Dodd served as a senator for 30 years. After serving in the House for 6 years, he was a key participant for decades in nearly every major national policy debate, and he authored major legislation in the areas of education, healthcare, foreign policy, and election reform, in addition to financial services. Barney Frank served 32 years in the House of Representatives after serving 12 years the people of Massachusetts in various city and local capacities. He, too, was at the forefront of virtually all the major issues facing the country over those decades. It is almost impossible to describe the complexity and difficulty in enacting any major legislation in the ordinary course. To do that under the historic and unprecedented circumstances facing the country in 2008, 2009, and 2010 infinitely multiplied the hurdles and made success a long shot at best. The good news was that during those years, as the Wall Street-caused financial and economic catastrophe slammed the country, both of these men were at the height of their legislative power. Chris was chairman of the Senate Banking Committee. Barney was the chairman of the House Financial Services Committee. And at that point in their careers, they were well-known and highly regarded statesmen and very sophisticated legislators. Any serious legislative effort, a response to the financial crash and the economic crisis, would only happen if those two leaders could steer it through their respective committees, then through and off the House and Senate floors, and then a conference committee, all the while keeping the leaders of Congress and the administration on board, not to mention the innumerable, very powerful outside groups and constituencies. And of course, they had to do all of that, as President Obama said, in the face of daily, unrelenting opposition from the entrenched and well-funded opposition who tried to block any reform at all. As if that wasn't enough, all that had to be done under intense media scrutiny. The challenge for Senator Dodd in the Senate was multiplied because he was also the leader on the historic healthcare legislation moving through the Senate at the same time. And filling in for my former boss and Chris and Barney's dear friend, Senator Ted Kennedy, who we lost in August of 2009. So in addition to doing everything under the banking committee activities, he was also shouldering and carrying the torch on healthcare legislation. To say the least, the task facing Chris and Barney was truly daunting, if not Sisyphean. The fact that we're hearing from them today, 10 years after passage of the landmark legislation which bears their name, validates what I and many others believe, that they were uniquely positioned and talented to bring to fruition probably the most important piece of banking and financial legislation ever enacted into law. I say that based on personal experience because I was privileged to be on the Senate floor for most of the consideration and passage of the Senate bill and then the Dodd-Frank Act itself. No one will ever know how truly difficult this undertaking was, and no words will ever fully capture the achievement. Now, none of that is to say that the law was perfect. It was not. No law is, particularly one that intends to re-regulate one of the most complex and sprawling sectors of the economy. However, it was the best law the U.S. political system could produce at the time, and remember, it passed without one vote to spare. All things considered, including that the most powerful, wealthy industry in the history of the world opposed it with unmatched ferocity, it has been an effective law, responsive to the causes of the crisis, and by the time the Obama administration left office, it was well on its way to being properly implemented. And as I mentioned earlier, and as we've detailed in the reports I talked about, it has also been responsible for preventing the current pandemic-caused economic crisis from becoming a banking crisis. Now, in thinking of a moderator with the subject matter expertise and journalistic acumen to illuminate the backstory behind the making of the legislation and its ongoing importance, my first thought was Stephanie Ruhle. Stephanie is the senior business correspondent for NBC News and the anchor on her widely watched daily show, MSNBC Live. She brings a practitioner's experience and eye to all these issues, having worked for many years in the financial industry and the markets. As a result, she has street cred and knowledge and well understands the nexus between finance and Washington. Her coverage of these areas, including the CARES Act, what's going on with the pandemic and everything going on now, is as informed and insightful as you will find anywhere. With that, I turn it over to Chris, Barney, and Stephanie.
Ended up in television because I sold credit derivatives for a living to hedge funds at Deutsche Bank, and the financial crisis and Dodd-Frank put me out of business. So that's sort of how I ended up here. Thank you so much. This is such an important day, and it's an honor to be with both of you. I would love it if we could start with a little bit of a history lesson. 10 years ago, you were in the room for the most important conversations, for the conversations that began with President Bush's financial regulators sort of briefing Congress that we had, impending economic collapse through our financial system. So can you take us back to sort of when this all began? Chris?
Well, first of all, let me thank Better Markets and Dennis Kelleher, a good friend over here. I'm delighted to be my partner, and here, Barney Frank. We had a great relationship together working on this bill and other matters over the years. Thank you to George Washington University and President Obama. Barney and I were both clear this wouldn't have happened without an administration that was tremendously supportive. Yeah. And the other panelists you'll have on, including Lauren later.
They need to be able to see you.
Dealing with the Consumer Protection Bureau. You're absolutely correct. I'm glad you began, Stephanie, with that question, because it's important to remember what Barney and I went through in the fall, the summer and the fall, the Congress did, dealing with the collapse. Pelosi's conference room on September 18, 2008, when we were told by the chairman of the Federal Reserve Board, Chairman Bernanke, that unless we acted in the Congress in a matter of days, a good part of the financial system of the United States and the world would melt down. Didn't say it in a hyperbolic way. It was very calm, but very factual, very clear. And so we left that meeting wondering whether or not we could pull together a piece of legislation that would manage to get us out of the immediate problem, which we did with the TARP legislation. Maybe the most unpopular thing that Barney and I maybe ever did in our tenure in public service. And I will go to my grave believing one of the most necessary things we did. That led, of course, to the efforts with the financial reform bill. Barney and I would both tell you that the healthcare issue intervened. And if I had to go back and do it over again, I would suggest that we ought to start immediately after the crisis of the summer of 2008. By the time we got around to 2010, so today, the signing ceremony, a lot of the public had moved on. The memories of what had happened in the summer and the fall of 2008 were fading. And so we acted when we did, but it was not easy. And then lastly, I would just mention this, and it's important to remember this. In the summer and the fall of 2008, you had the Congress controlled by Democrats, the White House controlled by the President Bush's administration. We were 40 days away from a national election. Not exactly the time when you'd normally be expecting how to come together, pull together to try and get our country back on its feet again. And were it not for Barney working what he did in the House, I was blessed to have colleagues of mine in the Senate who understood it. We were able to get over that hump. And then we had to, of course, go forward and try and deal with the very problems that created the mess to begin with, which became the Dodd-Frank bill.
Wow. Congressman Frank, can you hear us?
Yes.
Take us back to when this all first began, how you started crafting Dodd-Frank. When you think about the gargantuan task and the disaster that we were in, it's extraordinary that you were able to make this happen. So can you sort of take us back to the room or the rooms or that time period?
It begins early in 2008. And one of the things that should be stressed here, I think Dennis has made this point, this became partisan, unfortunately, in Congress because the Republicans basically refused to cooperate with us. Chris had some cooperation early on, which he worked for, and then they decided to pull the plug on that. I never had much cooperation in the House side. But this began very collaboratively with the Bush administration. And, people ask, when did vicious partisanship begin in America? January 21st, 2009, when Barack Obama became president, because from 2007, 8, 9, and 10, two Democratic houses, House and Senate, worked very closely with the Bush administration in dealing with this. And we began in 2008, and the first indication I had was when the Bush administration engineered the takeover of Bear Stearns by J.P. Morgan Chase. And at that point, Bernanke and Paulson, the leaders of the financial policy of the Bush administration, explained that they thought we were in trouble and that if a major institution failed, we wouldn't be able to handle that. And of course, that became true when Lehman failed. And they wanted to talk about changing that. And as we explained to them, getting the Congress to move in that situation, interestingly, with almost overwhelming Republican opposition to what the Bush administration was asking, would be very hard. And so we stayed in touch with them. On the House side, we were moving on adopting legislation to deal with the mortgage problem. We actually got a bill passed that ultimately became part of the larger bill. But we didn't have the political heft to do anything major until the crisis hit, unfortunately. At that point in September, we did have very strong cooperation, House, Senate, and the executive. Interestingly, the Senate was bipartisan at that point. Senator Shelby, the leading Republican, was opposed to it, but he wasn't obstructive. The Senate Republicans on the whole were supportive. Several of them, by the way, paid a price for that in the next year when they got defeated in primaries. Kay Bailey Hutchinson in Texas, Bob Bennett in Utah. So we had the House Democrats, the Senate Republicans and Democrats, and the administration. And at that point, we began to work fairly closely together, and including, by the way, while obviously this was immediately dealing with the crisis through the funding for lending the money to the bank, we set the basic outlines to a great extent of the legislation as well. And people should understand when the right wing, when President Trump, when others denounced this legislation as a Democratic overreach, they should understand that all of the major regulators appointed by George W. Bush agree with the basic outlines of the bill.
Then I want to reference the report that Better Markets released today on Dodd-Frank has this whole section about it being a bipartisan bill, although it was enacted in a largely partisan vote. Senator, do you agree with that?
Absolutely. I'm glad that Dennis made that point in the bill. Others have already, John Reed. We only passed the bill because we had a supermajority. And we were able to, 3 Republicans in the Senate supported the bill. We lost a Democrat. Ted Kennedy had passed away. And so it was right on the margins. So the actual outcome looks partisan. But I can go back through that bill, any number of instances, and point out the bipartisan nature of what's in the bill. I wrote down some of them here just to make the point. The Office of Financial Research in the Treasury Department. That was a Republican idea to put it in the Department of Treasury. FSOCs, for those who wanted to create an independent department, we put that in the Treasury Department at the behest of our Republican friends. Making the Consumer Financial Protection Bureau an independent agency, my friend Bob Corker of Tennessee was the author of that idea along the way. And then we did things like, I never told anybody ahead of time, but I invited Democrats and Republicans to share responsibility for various aspects of a very complicated proposal. And so I had Mark Warner and Bob Corker deal with Too Big to Fail. Chuck Schumer and Mike Crapo dealt with I think corporate governance. I had Jack Reed and Judge Reg deal with the derivatives market. Shelby and I worked on the Consumer Protection Bureau. So we had that cooperation didn't solve every problem, but it produced some very positive results in the process going forward. And then on the floor of the Senate, we debated 60 amendments. Half of them were Republican amendments. About 10 of them were accepted unanimously. Another 5 or 8 of them were debated amendments, and Republicans carried the day. And I never demanded a 60-vote margin except on one of the 60 amendments. So if you had 50 votes, you could win or lose, rather than creating super majorities on every single vote you had, which has become routine today. So we made a real effort. Hank Paulson, when we finished the bill, used language very positive describing what was in the bill. In fact, a lot of the bill, one of the kept secrets, if you will, is that Barney and I followed to some extent the recommendations of the G20, which was a proposal signed by world leaders, including President Bush. Now, we didn't go letter for letter, but we understood the value not just of having a financial bill dealing with architecture and structure at home, but to what extent could we get cooperation globally? Not verbatim cooperation, but at least agreeing on principle. And so following the G20 to some extent, a document endorsed and signed by the Bush administration, I think is another example of the kind of, quote, bipartisanship that we sought to have. And I made a Herculean effort in the Senate to get any Republican from the very beginning. And Bob Corker really was the only Republican to begin with who was willing to sit down and work with me. And we did for weeks on end to try and pull the bill together. So I take great offense as someone who spent 30 years in the Senate following the model of senators who preceded me, who cherished the idea of getting cooperation between the two parties to move major issues forward. So it was not for any lack of effort. In fact, in many cases, actually succeeding to have a significant amount of Republican participation in the adoption of this bill.
Congressman Frank, what do you think?
Somewhat different experience because historically the Senate has been a somewhat civilizing influence on House members who are free to be a little bit more rambunctious with smaller districts, although that has substantially diminished over time. And I think the difference in that regard between the House and Senate is gone, partly because, as I said, several of the Republican senators who were taking the lead in being bipartisan during the crisis were defeated in primaries in 2010. Mike Castle from Delaware, who lost to the, I think I am not a witch person in the primary, fortunately. Kay Bailey Hutchinson, they called her Kay Bailout Hutchinson. Poor Bob Bennett, a very impressive, thoughtful guy, couldn't even get on the ballot in Utah because of anger, because he'd been too cooperative. But on the House side, I had trouble beginning in 2008. We were passing a bill, or maybe late 2007. We were passing the bill to restrict the sale of mortgages that shouldn't be sold. Ironically, of course, the right wing said, "Oh, you liberals, you gave all these mortgages to people who shouldn't have gotten them." When we passed in the House the bill to restrict bad mortgages, the Wall Street Journal attacked me for restricting minorities' ability to buy these houses. Spencer Backus, who was then leading Republican, the senior Republican on our committee, supported the bill and brought with him a significant minority of Republicans. As a result of him supporting this bill to ban abusive, predatory mortgages that were the source of the problem more than anything else because they couldn't be repaid, he almost lost his position. Some of the conservative Republicans, including the later chairman, Jeff Hensley, complained to the Republican leadership that he was being much too cooperative with us. And he had to fight very hard to get his position back. And he, as part of that, he had monitors. He had Republican leadership people installed to watch him. I once complained to him about a statement he had issued that was really more off the wall than usual. And he explained that it wasn't his statement. It was one that had been written in the Republican leadership office, and he had to sign it. So, and then, of course, we had the TARP when the majority of House Republicans voted against that bill both times, heavily the first time, not quite as heavily the last time, but here we are in this terrible crisis, and there's bipartisanship in the Senate under Chris's leadership, but in the House, even on the second vote, even after the stock market has had its biggest one-day loss ever up to that time, a majority of House Republicans still voted against it, and the Republican leadership explanation was that Nancy Pelosi had made a speech that they thought was too partisan, so to punish her, they voted against their president's proposal to save the economy. Therefore, it was no surprise to us when in the House the next year when we were doing the bill, we got virtually no Republican support. I think we had two Republicans. One was a kind of an accidental Republican who was a Republican from New Orleans, the only one I think since Benjamin Butler after the Civil War, and he served a few months because of a Democrat who got sent to prison, and then Mike Castle, who was defeated in the primary in Delaware the following year.
Senator, you had said in the beginning that by the time this happened in 2010, a lot of people had forgotten all the problems that we faced in 2008 and how complicated things were. Just in the last few minutes, when I hear the two of you speak about all of what this legislative process encompassed, was this the most difficult, technically difficult thing you had ever taken on? And your teams, when you think about all that you had to cover?
Well, it was. And it just seemed to me that we couldn't go through what we'd gone through in 2006, actually, 2007, 2008, and come back out and leave it because we had taken a sizable hunk of taxpayer money and given it to invest in many healthy lending institutions and walk away as if the problems had been solved. In fact, for decades, people have been talking about the reform of the financial services architecture. But typically in our country, in a democracy, it takes a crisis to get people to move. The problem in this case was, and I understand the administration's point, they had a chance, they really wanted to deal with healthcare and decided to move on that directly. Of course, President Obama was just coming into office. So the following half really consumed that very difficult process. We watched the Congress and the country become more polarized. And so for all of those reasons, the delay in coming around to the bill again, the delay in resulting in the kind of heightened partisanship made it more difficult. And given the magnitude of the issue, we didn't solve every problem. We didn't intend to. Here there are a lot of issues. We'll probably talk about some of them that might have wanted to include if we had been able to write exactly what we wanted to in a bill like this. So it was tremendously complex. But I'm glad I did what I mentioned to you earlier, Stephanie, and that is by involving my colleagues on the committee to become part of the problem solving. This couldn't fall entirely to a chairman of the committee. I always felt the best chairman I watched were people who made an effort to include their members in the crafting of ideas, get them invested in the product, if you would. And so that made a big difference because people became engaged. They were asking to contribute their ideas and thoughts to making the bill work. And that really helped tremendously.
But even contributing ideas and thoughts, Congressman Frank, how much of a financial services architecture education did you need?
A lot. Let me say something that I know Chris agrees with, and he's said it himself. None of this would have been remotely possible with one of the great underappreciated assets in America. The wonderful, bright, dedicated, self-sacrificing women and men who serve as our staff. Chris and I were both lucky to have, although obviously it wasn't random, we get some credit, but we had people working for us who were as talented as anybody, who were doing it for much less money, in much worse conditions, physically and in every other way. And so that was the main thing, that these people, I could not have understood all this, and Chris couldn't have, but collectively we had a great deal of help. Even with that, it was tricky. You ask about what the experience was like. I went to bed. Now, I wasn't going to get any Republicans. When we passed the bill that year, there were 71 members of the committee, 42 Democrats and 29 Republicans. I literally went to bed on nights when I had trouble sleeping, counting Democrats. I couldn't go to sleep until I got to 36 on any given issue. We had a series of markups on this bill. And literally until I got to 36, I would have trouble sleeping. Fortunately, we did on almost every issue. But yeah, it was complicated by several things. First of all, the substance. Then, remember, we were not an island here. We had to consider the impact of other countries, the competitive position of America might be importing. We had that whole set of things. I noticed just recently that the former Prime Minister of France, François Fillon, was indicted. And I remembered at the time that he was actually in my office because the French embassy in Washington, stupidly, is about a foot from Maryland. So to get from the French embassy to Capitol Hill takes about 2 hours during rush hour. And he wanted to talk to me, and I could not get there. We had votes. So I had the president of France in my office, which my father would have appreciated. And you had that set of things going as well. And we also had, you talk about architecture, one of the big issues also then was the multiplicity of regulators we had. And I got to say, I was struck. One of the things that strikes me is the extent to which Republicans made very partisan criticisms of what we did. And then from 2011 until the beginning of 2019, they did virtually nothing to correct any of what they said were grave errors. And in a forum we had recently that was put on by Brookings with Chris's leadership, a high-ranking White House economic official criticized us because we hadn't done anything to diminish the number of regulators. And I didn't get a chance to ask him, but for the 2 years that Donald Trump had a Republican House and Senate, they didn't do a thing in that regard. But yeah, it was substantively complicated, politically complicated. There were international implications. It really was I would say it was a Rubik's Cube, except I have never been able to solve a Rubik's Cube, and we did get through this one.
Let me add, Stephanie, to you. Let me add on the point that Bonnie made. First of all, let me second what he said about our staff and remarkable people who were involved in going through this with us. We did something else in the Senate. I suspect Bonnie did the same. I said to every outside interest. If you want to be heard, we're going to hear you. I won't necessarily be involved in these conversations. But if you have something you want to share with the Senate Banking Committee, I will guarantee you'll get an opportunity to be heard. And I don't know of anyone who didn't take advantage of that. Some may not have. But I wanted to make sure that door was open. That they couldn't at the end of the process say, I couldn't even be heard on an issue. So my staff, in addition to offering great counsel and advice and working with Barney's and other members, also spent a lot of time with stakeholders in the bill that we were proposing and gave each and every one of them an opportunity to be heard on their various ideas. And that, I think, played an important role as well.
Senator, we rarely see anyone in government give anyone else, definitely from previous administrations, credit. But here we are facing an economic crisis today that was sparked by a health crisis. And our globally significant financial institutions are actually in very good shape. Lending practices are working. The pipes that you cleaned up and retooled through Dodd-Frank are working. If Dodd-Frank wasn't enacted, what situation do you think we would be in right now, given what's happening economically?
I think we would have collapsed economically. How we would have come out of this if we didn't have banks with the capital, the liquidity, their ability, their profitability, their strength to be able to play such a constructive role over the last 20 weeks. And I don't know of anyone who disagrees with that, nor do they disagree with the conclusion that had we had the complication of a financial system that could not respond, as well as the pandemic and all of the economic implications of that, we'd be in such a deep hole. I worry if we could get out of it. So I know we didn't, with all of our stress testing and going forward, no one envisioned dealing with a pandemic, a global pandemic. But I happen to believe, and others who are following this now more closely than I am, have said over and over again, that the strength of our financial institutions has made an incredible difference. We've got a long way to go, obviously, and we've got deep economic problems, but they would have been far, far worse had we not done what we did 10 years ago.
There's also a wide array of financial institutions, banks alone. Congressman, when you think there's really only about 10 global, significantly important banks, I mean the behemoth Wall Street banks, then beneath them there are thousands of community and regional banks out there. How complicated was that for you to create this legislation, knowing that so many of these institutions serve different purposes and serve different customers?
I should say at the beginning, I am a member of the board of directors of an important regional bank, and I think people should, you always want to make that clear. Well, for instance, it explains one of the issues that I just referred to. One of the complaints we had was we have too much duplication in regulation. And there were three major examples of it. We resolved one of them. There was both the Office of the Control of the Currency and the Office of Thrift Supervision, which chartered national banks. The Office of Thrift Supervision was for savings and loans. The Control of the Currency was for commercial banks. The Office of Thrift Supervision developed a deserved reputation for being kind of easy on the people they regulated. We ultimately abolished them. We merged them with the OCC. My plan B there was to change their name to the Office of Fig Leaf Dispensation. But we did resolve that conflict. But the other two we couldn't touch for political reasons. One was the split, and it's crazy, that derivatives are regulated by both the Commodities Futures Trading Commission and the Securities and Exchange Commission. Derivatives started out as based on commodities. That's why it's the Commodities Futures Trading Commission. Then the financialization of derivatives took over. The SEC got involved. But if you tried to merge those two, you would have the farm community furious that the financial big shots were taking over. But the other one, where Chris took a courageous lead, was to try to consolidate regulation of banks between the Office of the Control of the Currency that regulates national banks and the Federal Reserve that regulates state chartered banks. And there was a proposal to merge them, and it was vetoed by the most politically influential group that we were dealing with, precisely who you talked about, the multitude of community banks. They have much more power than Citibank or Bank of America because they've got people in everybody's district who are civically active and friends of the members, and they have employees in everybody's district. And the head of the independent community bankers, many of which are state chartered, came and said, look, there's no way you can put us in the same regulator as the big guys. If there was a common regulator, if it was either the Fed or the OCC, then the smaller banks and JP Morgan Chase would have the same regulator. And they said, no, one size doesn't come close to fitting well. So they vetoed that effectively. Also, when we drafted the bill, we frankly made several changes in favor of the community banks. They are not inspected by the CFPB. They're covered by its rules, but the CFPB doesn't send a team to examine them because they said that would cost too much. We had a fight over deposit insurance. We raised it from $100 to $250 to protect small banks from losing deposits of a large amount to bigger banks who are perceived to be, quote, safer, unquote. I wanted to do it even more. The big banks fought us on that one, but that was another example of where we did some differentiation. Finally, and I think we didn't do it enough, and Chris and I supported, not entirely the whole bill, but a part of the bill that passed last 2018, which exempted banks under $10 billion from the Volcker rule and said banks, again, under $10 billion in assets could make loans that would otherwise be dubious as long as they were to keep them in their own portfolio. In other words, run the risk themselves. So we did do some differentiation in the original bill, and in two respects, I think, improved upon it.
Senator, what about the non-banks, the financial institutions that were also part of this, the AIGs, the Lehman Brothers, the hedge funds, the private equity firms? How did you factor in their roles, what kind of regulations they needed, and this legislation? And their huge
part of it
lobbying
was
effort.
with the FSOC. Yeah, with the FSOC was an effort. Obviously, the Financial Stability Oversight Council was the idea to look at systemically important, systemically risky institutions. And it wasn't confined, obviously, to ones that qualified by definition or legal definition, so that we could take a look at some of them. And this has been a source of significant contention until recently. I was the Secretary Mnuchin talk about the fact that stock would have value. The idea that we ought to be identifying potential product lines or institutions that pose systemic risk to the whole industry. So that was a major step in moving in that direction. Obviously, looking at product lines, we talked about the transparency issues on other issues like derivatives and so forth. I think will help as well in providing us with better information about what's occurring in those financial service areas. And it's all working well today, by the way. All the concerns that were raised about the fact that this is going to create future problems have not turned out to be the case. One point that Barney has made over and over again, and I agree with him on, and that is we had a lot of complaints about people saying, well, you stripped the ability of the Federal Reserve system to respond to a future crisis by providing capital during times of deep difficulty, such as one we're going through. It turned out that Jay Powell has proved them all wrong. In fact, was able to take advantage. The 13.3 section, I don't want to bore people with too many details, but the 13.3 section is working fine in a sense. That the capital has become available, and as a result, we've been able to handle at least part of the economic crisis we're dealing with today. So again, I think we had needed to understand the growing presence of sort of the shadow banking system has posed some significant problems. The CFPB, the Consumer Financial Protection Bureau, is not limited. They've been looking at payday lenders and other matters. Some of them would qualify, I suppose, but others would not. in terms of how consumers get injured and harmed by an institution that doesn't meet the legal or technical definition of a financial institution or a bank, can also be the subject of their efforts.
Okay, they're looking at the payday lenders, but does it disappoint you to see that all of the progress that you made, somewhat of which is being undone right now? Payday lenders today are far more emboldened than they were 2 years ago. We saw payday lenders in the last month receive PPP loans from the government. And then if you want to tack in the shadow banking, look at all that private equity funds have done in the last 5 or so years. And now they're watching middle market companies that they own. They're watching those stocks get bought up by the Fed.
Well, again, your opening remark, I'm disappointed on some of these specific issues. But let me come back and reinforce the point that's been made by others already today in this conference, is we now have the structure and the architecture to address those issues under the proper administration. Barney and I never guaranteed that we would be able to solve all future problems. And the political system in this country elects where votes matter. And so we lost the head of the Consumer Protection Bureau. We had the head of the budget become the temporary head of the CFPB. The fact that they're still there, and the Supreme Court decision the other day, where I'm sure our opponents were praying that the court would declare the entire act unconstitutional, or at least the CFPB unconstitutional, proved to be quite the opposite. So I'm disappointed by some of the decisions, but I want to remind people today in this conference, we're not going anywhere. There was no efforts really made to repeal Dodd-Frank, as it was in healthcare. And yeah, they made some votes and things that I didn't like. I would have voted against them myself, but they didn't go to the heart of what we've done. The heart of what we did 10 years ago is the law of the land today in the United States.
Was there not the political will or the lobbying effort will to repeal Dodd-Frank, Congressman? Because at the end of the day, it worked. If you talk to some of the biggest bank CEOs over the last 10 years, when Dodd-Frank was first introduced, they were devastated. They thought it would crush their business. And then in the subsequent years, you saw those same CEOs say, by the way, Dodd-Frank made us better and smarter and stronger.
Two things I would say about that. First of all, you're right that it was political fear that kept the Republicans from doing this. The fact is that even during the angriest times with the Tea Party and the upset about the TARP, which was at the same time one of the most successful and unpopular things the federal government ever did, financial reform was popular. The Consumer Bureau in particular. So the Republicans, while the ideologues wanted to go after it, the Republican leadership was told by most of their members, I don't want to have to vote on that. I don't want to have to choose between the Tea Party and the bulk of my voters. So, as Chris noted, it's a great contrast where they tried to repeal healthcare, which later became more popular, and financial reform, which was always more popular. And as to the big banks, I think they discovered two things. First of all, and this was a factor, there was pressure on the banks. There's pressure on people in any industry to go to the bottom. If your competitors, for stock investors, for customers, for whatever, are engaging in activities that aren't the right sort morally, but look profitable, you can be heard. We have the famous statement from Chuck Prince, who was at Citicorp. When the music's playing, you got to dance. I asked him at one point why he was using a technique that allowed the bank to incur debt but keep it off the balance sheet. I think it was called the Structural Investment Vehicle, the SIV appropriately. He said, well, if I don't do this, Goldman will beat me in the stock market because their balance sheet will look better. It also, I think, helped us internationally. The fact that American financial institutions, including our stock market, have a reputation for being very well regulated is a source of strength. It is one of the reasons why the dollar is so strong, why this is still a place people want to put their money. And one of the reasons is that they're safe here. And so you have this competitive protection against inappropriate action. You have the reputation for safety and the fact that, frankly, we knew what we were doing. And what we banned, and this is the key, what we prevented people from doing was incurring, it comes down to incurring more debt that they could handle. And absent regulation, you could get some kind of, you had competitive pressure to do the things that incurred more debt that you could handle. And we have relieved every financial institution that wants to be responsible from the pressure not to be.
In his remarks earlier today, President Obama said this: "We were met every step of the way by entrenched and well-funded opposition who tried to block any reform at all." During this whole debate back in 2009, President Obama also said this. He was calling out Republican leaders and said, just last week, Republican leaders in the House summoned more than 100 key lobbyists for the financial industry to a pep rally and urged them to redouble their efforts to block meaningful financial reform. Not that they needed the encouragement. The industry lobbyists had already spent more than $300 million on lobbying that year. Given that this was the worst financial crisis since the Great Depression and that an economic crisis isn't partisan, were you surprised, Senator, that you were met with such ferocious opposition from the industry that had largely brought this upon themselves, and then how quickly it became so partisan?
Well, yeah, certainly it was. And I was surprised that the industry didn't step up earlier. I remember I made a recommendation to some of the people in the financial services sector when the problems first emerged in '08. It may sound simple to people, but I said, why don't you come on down to Washington and bring a bunch of your brightest young people who know this industry well, take out the top floor of one of the hotels, roll up your sleeves, and offer to go to work on behalf of the country, free of charge, to help us get back on our feet again. They were just tone deaf, it seems to me, about recognizing it was a moment for them to step up and help get us back on a better track than we were clearly on. And for whatever reason, I don't know who was listening or who they were listening to politically, but they were just digging a deeper hole for themselves all the time. Someone suggested we ought to mention some things that people may not be aware of. I remember going and meeting with the Financial Services Roundtable. Now, it predates a lot of this, but nonetheless, it's instructive. And that's a big group. That's your largest institutions that come to Washington once a year and talk about these issues. And this was, again, predated the actual events of the catastrophe. But I got excited about it. It was 2007. I thought, well, this is my first chance as the chairman of the banking committee to listen. And basically two issues they wanted to bring up. They were frightened to death of a Consumer Protection Bureau, and they wanted to talk about executive compensation. I remember leaving the room thinking, here they had the chairman of the Senate Banking Committee. There are a lot of these product lines which are complicated. And here's an opportunity for it to maybe educate me from their perspective on things that I ought to understand better. And it was just stunning to me that the major issues they wanted to talk about were their pay and a bureau that would protect the very customers they try to service every day from being taken advantage of. So they were tone deaf through all of this. Now, the good news is you're not today.
Surprised by that or disappointed by that?
Normally you think they're getting advice, whether they thought of themselves. I thought, well, someone's going to pull them aside and say, listen, we just went through the bailing out major institutions here with billions of dollars from taxpayers. I remember one of the fights we had, and Bonnie will remember, 1:30 in the morning before the TARP vote. Frankly, it was Hank Paulson was very upset that we were going to put restrictions on executive compensation as part of the TARP package. And I said, you're kidding me. We're asking the taxpayer to write a check for $700 billion, and you still want to be able to get, bonuses. And finally, Hank said, forget it, they won't sign on to the TARP bill. Well, we managed to prevail that particular argument that night at 2:00 in the morning. But that was sort of the mentality we were going through. So yeah, it was surprising to me. There was a bitter price. People didn't realize the moment they were in. But let me just say in fairness, I think today they're doing a much better job. I think their reputations are better. More work needs to be done. But I'm it's showing me a lot wiser industry politically than they certainly were in '07 and '08. That's for sure. 10.
Well, hubris and extreme wealth can often delay one's ability to be a little bit more self-aware. Congressman, when you think back, were there any points where you thought this thing isn't going to happen? We're not going to get this legislation through. And were there things you maybe had to leave on the table in order to get it through?
You're right. Let me just add a little bit to what Chris said. I was struck, and it's true. Hank Paulson, with whom I agreed on a lot of things, just put up a terrific fight, and his argument was interesting. It was that if we put restrictions on executive compensation, the executive in question would refuse to participate. Now, understand what that means. This was a program that they presumably understood was going to save the economy. And people making much more money than any human being could probably spend in 2 lifetimes in a couple of years were objecting to a fairly small reduction in their compensation and was so angry that Paulson thought they might walk away from this cooperative effort. And I got to say, that was an impugning of their patriotism. I also think, I never read War and Peace. I'm going to read it after I do a Rubik's Cube. But there is one part of it that seems to me very, very relevant. There's a guy, he's a prince, and I can't tell you, I forget his name, but he's played by Henry Fonda in the movie. And he's riding in a battle against Napoleon, and he says, "My God, they're shooting at me, who everybody loves." And that was the impression I got from some of the financial executives. They were used to being lionized and treated very respectfully and held out to be these great wizards. And all of a sudden, people are yelling at them. And you remember that ridiculous comment from Goldman Sachs from Lloyd, we're doing God's work. And I think a large part of it was that, or was Steve Schwartzman talking about, this was like Kristallnacht. I mean, they were just offended. They couldn't believe that we were all, as a country, so ungrateful to them for the great benefits they'd given us. As to when did I think it might fall apart, there were 2 points. One was when we ran into a problem, and I said the big banks generally didn't have much influence. But there was one point where there was an issue actually over a federal preemption of state law. And the Bush administration had put through a program whereby states had no power to regulate banks. They could only be regulated by the federal people, the national banks. And we were reversing that substantially. And the biggest banks were so upset about that we had a problem with some of our New York Democrats and Chicago Democrats who represented areas where the big banks had a lot of employees, and that was their crowd, not contributions. And there was a serious problem there. Steny Hoyer, who's a great legislative technician, I went to him and said, "Steny, this could come down over this." And he negotiated a deal so that we preserved the importance of allowing the states with some compromise. The other issue, very relevant to today, there was a large number of African Americans on the committee then and now, because it was always a committee of urban jurisdiction and housing. And the African American community was hurt worse than anybody else by the financial crisis, including, by the way, the fact that African American banks had been major purchasers of the preferred stock, technical point, Fannie Mae and Freddie Mac. A number of them were in trouble. We were trying to protect them. And a number of the African American members were told by their constituents, "Hey, you're saving America, how about us?" And the group, led by Maxine Waters, now the chair, and some others, that included, I think, all of the 9 or 10 members of the Congressional Black Caucus, said they couldn't vote for the bill unless we got some major concessions. And I did ask, and Rahm Emanuel came and talked, and we made some progress to the point where they didn't vote against the bill, but they didn't vote for it. They absented themselves from the meeting, and we won by 1 vote. That was one of the nights when I kept counting Democrats and finally got to 36. Was okay. So those were the 2 crisis point. They were, and by the way, and I want to make this point, and I know the view is that there's too much money in politics, and I generally agree with that, except on those occasions when I needed some. But the fact is that as we made this bill and we dealt with it, and I think Chris will agree, the obstacles we ran into were most of them, either honest ideological opposition from some people, or constituent pressure. Campaign contributions had, in my experience, I do not remember, and we talk honestly to each other in private, I don't remember anybody ever suggesting that they couldn't do a certain thing on our committee or even in the House as a whole because of contributions. People told me I can't vote for that because of this constituency group. Or I just think you're not being tough enough. But I think and Bob Kaiser has written this wonderful book about the process, and I think you see when you read that, honest conviction and political constituent pressure were by far the greater influences than campaign contributions, even when we're talking about regulating the richest people in America.
How did you deal with,
Stephanie,
yes?
Stephanie, I've got to make one correction, Stephanie, if I can. This is where modern technology comes in. My staff sent me an email. Bob Corker was very helpful. He was going to suggest that the Federal Reserve is where the Consumer Protection Bureau should be housed. He was not the creator of the consumer. If I had said that, I apologize. That was a mistake. But Bob did play a role.
This illustrates the point you were both making earlier, the extraordinarily talented and selfless staffs you both had and have to this day. Can you give us an example, a non-public story, something we haven't heard yet, and you can change names or leave them out to protect one's identities, that sort of illustrates the thrill of victory or agony of defeat in terms of going through this process? Senator?
Well, there are quite a few moments. I thought it was a great question, and I think we'll protect the innocent in all this, but certainly a moment that Barney and I can both share, having gone through it. Literally, and I'm not exaggerating here, the vote on the floor of the Senate was occurring, the final passage of the bill. And all of a sudden, one of my supporters indicated they had a problem, and couldn't vote for the bill. Well, if I got 59 votes, we'd not be having this conversation today, Stephanie. And so it involved New England, and I got a hold of my friend in the House, who I think, Barney, without telling state secrets, I think you were in the House gym, because he would have voted on this. And I called Barney and I said, we got a problem. Now the vote's occurring. And it took about 10 minutes or so, but we resolved the problem with Barney's assistance and help with people he was aware of and knew. And the person ended up voting for the bill, and we got the 60th vote and passed. I don't know if that's written anywhere, but it was one of those critical moments. You can't get much closer than that when you're literally, the clock is running and the votes are counting. And had we lost that vote, we would have been having an intellectual conversation today about Dodd-Frank, not a discussion about the signing of the bill. That's one. I'll tell them more, but that's one. I don't know if Barney remembers that or not. It's pretty critical.
Congressman, how about for you?
Well, that was clearly one of them where we were involved in. I was in the gym and went in my gym clothes to our offices to meet with our great staff director, Gene Lathanowick, and two of my staff, Jim Siegelman and Dave Smith, wound up in a sort of double negotiation, one with the senator in question, the other with Paul Volcker, because it involved the Volcker rule. And we worked it out. The one that bothered me, I will leave out the name. One of my regrets is that we weren't tough enough in the bill on the question of risk retention. I think anybody who incurs a debt for the society should have to bear some of the responsibility if that debt is not repaid. And we put the principle in, it was especially important for mortgages. And as we were getting into conference, a senator, and I used to talk about that, Chris gave you the context, it seemed to me that there were people who took turns being Senator 60. That is, they would come to you knowing that you had 59 votes, but you needed that senator to get to 60. And in this case, Senator 60 had been approached by mortgage brokers who wanted an exemption from the restriction that you couldn't securitize without some holding on to the risk for super good loans. And I didn't like the idea, was worried about it, but 60 is 60. And Chris, in his total good faith, and let me aside, one of the things I'm proud of, the House and the Senate don't get along the way they should. Egos get in the way, turf gets in the way, and here is one of the most complicated, politically treacherous legislative things you ever had to deal with, and there was never any friction between me and Chris, or between the House and the Senate through us in that regard, and our staff, to that credit, worked very well and cooperatively together. But I had to give in. And so we created this category for loans that could be exempt. I mean, there were supposed to be three kinds of loans. Loans that were so bad you couldn't make them. Loans that you could make but were subject to risk retention. And then the small category of loans that were golden and you didn't have to worry about risk retention. The trouble is those last two categories got the exception ate up the rule. Because of the language that was developed at this senator's complaint, the loophole became such that there are now two kinds of loans. Loans you can't make unless you're a small bank and want to keep in your portfolio, which is fine with me, you bear the risk. Or loans that are not subject to risk retention. Ironically, almost every other kind of securitization is subject to risk retention more heavily than loans. I think that's a good thing. So that was a loss that I didn't realize the dimensions until later, when a very interesting coalition of the banks and the liberal advocacy groups got together and insisted on broadening that loophole.
Yeah, good point.
No,
Stephanie, it's important.
Yes.
No, I was just going to say it's the other moment I was going to share, and Barney knows about this one as well. The Republicans came to us with a paid-for bill at the end of the conference. We had to have a paid-for for the cost of the bill. But large, but had to have a paid-for. They came up with one that we thought was acceptable, and I think Barney, I think there's a picture behind Barney's head. I don't know if that's the same picture, Barney, of us about 6 o'clock in the morning, and we're signing.
I can't get it in over.
Support. Moved to the Senate and House for votes. Again, a couple of Republicans, one particularly came and said, I can't vote for that paid for. I'm off the bill. Now I'm short again by one vote. I spent almost a day with a parliamentarian of the Senate, for something I'd never done before, to convince him that signing a conference report was not tantamount to voting for the conference report. So even though everyone had signed it, or not signed it, he had the majority of votes, and therefore there was no changing the conference report. And it literally took me almost a day to convince the parliamentarian to do something he had never agreed to before. And that was the signed conference report, until voted upon, has not been adopted, even though the conferees have signed it. So we had to reconvene the conference report, change the paid for to meet the concerns that have been raised, and then go back again. And again, one of those moments that, again, you're hanging by your fingernails. And the parliamentarian of the Senate said, I'm sorry, that's it, the bill would have died as well.
You have both been out of Congress for the last 10 years, but what you can give us is extraordinary perspective. You've both independently said throughout this hour that while it was hugely successful, it was enormously unpopular. I'm speaking about TARP. Yeah. Fast forward to the economic rescue that we're seeing today, the trillions of dollars that the U.S. government is giving to small and large businesses. You can also add in all that the Fed is doing. How concerned are you, Congressman, about the lack of oversight and the backlash that's to come?
I'm not as concerned as some of my friends. First of all, we are talking here about compensating people for something that was done to them, not by them. The problem with the TARP was that the many of the recipients of TARP funds were the malefactors. Although the federal government made money off every part of the TARP, ironically, except the one part of the TARP that was popular, the automobile loans. We remember the TARP money kept General Motors and Chrysler in business. And Ford said if they had gone out of business, Ford would have suffered too, because there would have been no supply chain. But the banks were the villains, many of them. And there are no villains here. None of this money is going to anybody who is held accountable for causing the crisis. Secondly, it's much more broadly shared. Everybody, many people are getting something, which is helpful. Even with that, yeah, there is some problem, but I have two responses to that. First of all, when we have people, and that's to say the unemployment, it's hard to do something in a very short period of time on a massive scale without error. So the question is, which errors are worse? To me, the errors of people in need, children who are stressed, parents who can't make it, people facing eviction, the possibility that they will not get any help troubles me a lot more than a couple of people who got help that shouldn't. We're a rich enough country when we're talking about this to err on the side of compassion. So that's why I don't worry as much. Secondly, it's a very difficult process to do this as in this time period. I think, frankly, it's been done on the whole rather well. But my basic point is this. Let me just take one example, the $600 stipend. You have some people, conservatives mostly, saying, well, don't do that, because if people can get that $600, some of them won't come back to work and the economy will be hurt. Yeah, but more of them are people who need that $600. And I'm more distressed at the thought that there are families, children, other people who will be in real pain if they don't get the $600 than the small number of people who might be taking a free ride on it. So again, I would err on the side of keeping it going.
Senator, what do you think?
I agree with Barney. I think it makes sense. Obviously, we got a major problem come this fall. I know they're grappling with the issue now in the Senate and the House on the third or fourth tranche of assistance. I hope it's going to focus again on caring for other people, children, child care. You're never going to get the economy moving again. I authored back 30 years ago the Act for Better Child Care, the first child care program since World War II. That was a fight then to get it done because we were dealing with a generation that didn't understand how important that is today. You cannot recover without it. So I'm hopeful they can do some of these things to allow us to get through this until a vaccine comes up. I think it's tragic we have this kind of mindless opposition to people wearing masks in public gatherings here. It's stunning to me that national leaders, a national leader particularly, is advocating a policy different than all the advice to the contrary. So I think trying to help people through this until we get back on our feet again makes all the sense. And the point that Barney made is absolutely on target. This is not writing a check to people who created this problem. We are faced with a healthcare crisis, the likes of which we've never seen before. It's now exceeding, I think, the so-called Spanish flu of 100 years ago. And not to step up, not to do these things, I think would be indictable, reprehensible. So I agree with Barney entirely.
One thing that we've seen since the pandemic has caused this economic crisis, and we mentioned it earlier, is that our banking system is stronger and better since Dodd-Frank. However, we also see the huge growth in non-bank financial firms, private equity firms, hedge funds, for example. What needs to be done from a regulatory perspective around those types of institutions becoming so large that we're then arguing, well, they're too big to fail and they need to be rescued. They need to be rescued next when they put themselves in this situation and exaggerated the shadow banking system.
Is that to me or to Barney? Is it Barney?
Congressman.
We've done some of that. The way in which many of those non-banks were involved in the problem had to do with the one area where I think we had the worst problem and we successfully resolved it to a great extent, and even the Trump administration has gone along, and that's derivatives. As Paul Volcker called them instruments of financial mass destruction. We have resolved the derivative problem by putting them in exchanges, by requiring that counterparties be able to deal with it. And so the problem was in the past, non-banks could get involved in derivative situations, could sell credit default swaps or whatever. And so whatever their activities are, that won't happen. The importance of that is this. It was through the derivatives, I think, that the problems of particular institutions ricocheted through the system. If a particular private equity fund gets into trouble now and it gets hurt, it's not as interconnected to the financial system as we would be worried about. That is, I think we've gotten to the point where, we never try to protect people from losses. We shouldn't. But the losses now more likely fall on the people who incurred the losses without systemic connections that make it worse. And one of the things we did do is, in the bill, we regulated functions as well as institutions. Now, that doesn't mean no problems with what these are doing, but they're not necessarily financial regulatory problems. I think there's a strong role for antitrust, and I'm glad to see Democrats, for instance, in the House, Dave Cicilline and others, Senator Warren has talked about this. They're looking at the antitrust implications of these agglomerations and noting that among the negative effects appears to be depressing wages. And so there are negative social impacts from large financial institutions buying up a lot of companies that are not within the jurisdiction of financial regulation, but should be looked at in other ways.
Senator, does Congress always need a historic crisis to enact pro-consumer or pro-little guy legislation? Because it often seems that in good times, the bigger get bigger and bigger and bigger, and they keep pushing the limits until things get broken, and then we're in crisis.
Yeah, I don't. Yeah, that's pretty much the way it is and has been historically. I've often said, and I think Barney and I agree on this, we could have never passed Dodd-Frank in 2007 or even 2008. Maybe if we had tried early, I don't think so. We certainly couldn't have passed it in 2011 after the 2010 elections. Windows open up. You take advantage of a crisis, if you will, where people are focused on it. And you can then do some things that people would acknowledge should be done. But there doesn't seem that sense of the urgency of now that we've used that happens until people actually are feeling it. And so that's why it's so important. I said this, I know, at the beginning of our conversation, Stephanie, but we almost didn't get it done because we ended up acting later. And it sounds ridiculous to talk about less than 2 years later, but even 2 years later, the country moves on. We're listening to these huge issues today that go in front of us here. All of us at this gathered here like this and listening, well, we're only one hurricane away from changing the subject in America. And so you have to act when these moments occur or you miss them. And that was true of healthcare. It's true of financial reform. It's true of what we're dealing with now on the issue of minorities, of communities, and financial services, using the word systemic risk no longer to confine it to a bank or a hedge fund, but to realize now a virus can be a systemic risk. Climate change can be a systemic risk to insurance companies, to banks, to all these shadow banking institutions, things that go way beyond what we traditionally were thinking of when we passed this bill. So we've got a lot of work to do. If I were advising the banking committee today and others, we did a good job, but it's 10 years ago. I could now bank with this in my hand. I can make deposits from my cell phone. You can't do that. Couldn't do that 10 years ago. So technology's better. New instruments are emerging. There's a lot to be done here. We did a good job 10 years ago, and it's great to celebrate it and talk about it. But there's a lot of work, particularly in serving underserved communities, particularly minorities and rural communities. A lot to be done to make sure that redlining isn't no longer just a local issue, it's a national issue because of the availability of financial services. So I would hope that our successors in all of this would really realize there's a lot more work to be done. You've got a crisis in front of you. Let's take advantage of it here now and make sure we can do some things we've talked about for years. So that's why I agree with Barney, and it's a perfect moment to move.
Well, you certainly didn't let that crisis go to waste. I want to thank you both for all that you've done and for joining us today and spending this hour with us. Dennis, thank you for this opportunity. It was really great to be with all of you.
Yeah, thanks to the three of you. What a fantastic
Dennis,
discussion. We should make every member of the Financial Services Committee and the Senate Banking Committee watch this video and take the lesson of bipartisanship and the national interest. And maybe, Stephanie, we could get you up there and ask them a few pointed questions and make them answer them, and we get some progress around here. But it's really been a terrific discussion and a great public service from two giants who have been serving this country for so long and frankly continue to do so by offering their wisdom. So I can't thank you all enough.
It's now my pleasure to introduce Sheila Bair, who's had a long and distinguished career in government, academia, and finance. Twice named by Forbes magazine as the second most powerful woman in the world, she is perhaps best known as chair of the Federal Deposit Insurance Corporation, the FDIC, from 2006 to 2011, when she steered the agency with the greatest experience resolving banks during financial crises through the worst financial crisis since the Great Depression. Before her appointment by President George W. Bush in 2006 to lead the FDIC, her long experience in financial regulation included service on Senate Majority Leader Bob Dole's staff, as a commissioner of the Commodity and Futures Trading Commission, as a senior vice president of the New York Stock Exchange, and as assistant secretary for financial institutions in the Treasury Department. She's a frequent commentator and op-ed contributor on financial regulation and the student debt crisis, as well as author of the New York Times bestseller Bull by the Horns, her 2012 memoir of the financial crisis. For her efforts to protect bank depositors and homeowners during the crisis, she received the Kennedy Library's Profiles in Courage Award and was named by Time magazine as the Little Guy's Protector-in-Chief. Please join me in welcoming Sheila Bair.
Thank you, Jeremy. That was a really great introduction. I'd also like to thank Dennis Kelleher for all the leadership at Better Markets. He's done such a great job, and for organizing this amazing conference and for including me with such a distinguished lineup. And it is so distinguished. Oh my gosh, sharing a virtual stage with the former president, President Obama, and so many old friends and allies, John Reed, Senator Chris Dodd, Barney Frank, Sarah Bloom Raskin, who I've known for years, Chair Maxine Waters, who's done such a fabulous job as chair of the House Financial Services Committee, and of course my dear friend Elizabeth Warren, who I admire so much. We're all here today to celebrate the 10th anniversary of Dodd-Frank, to celebrate 10 years of financial stability made possible by Dodd-Frank and the hard-fought reforms that were enacted as a result of that law and its implementation in the wake of the financial crisis. Even after the terrible devastation of the great financial crisis, we still had to fight really hard to get that law done. As Senator Dodd and Congressman Frank pointed out in the earlier session, the votes were very close. It was really disappointing to me that only 3 Republicans, I'm a Republican, only 3 Republicans supported it at the end of the day. And once it was enacted, we really had to fight hard to get it implemented. And even once it became law, once it was signed, there were still people that were trying to undo pieces of it, some successfully, mostly not, though, most stayed intact. One area where I actually had to try to fend off my former colleagues, Tim Geithner, Ben Bernanke, and Hank Paulson, who really didn't like the bailout restrictions in Dodd-Frank. It pretty much did ban bailouts with a new process to deal with failed banks. And they even actually wrote a book dedicated to that whole topic last year, saying Congress should release these bailout prohibitions. And I countered in the Washington Post with an op-ed saying, no, I thought they were absolutely fine. And Congress fortunately agreed with me. They demurred. They didn't make any changes to Dodd-Frank on the bailout prohibitions. But I think now that we see the massive intervention that the Fed is bringing to the financial markets, I guess as nobody listening to this program probably thinks that Dodd-Frank was too restrictive on bailouts. So we kept those prohibitions against bailouts in. That was good. Kept most of it. Fortunately, kept the provisions related to capital, though, as I've said, those are, and I will talk about in a little bit, those are under assault right now. Because the best way to avoid bailouts is to have really high capital levels that will prevent failures, and then you don't have to worry about it. But even those capital rules are under assault, and I'll be talking about that shortly. There have been some provisions that have been eviscerated, unfortunately, mainly by regulators. I'm thinking of the Volcker Rule. Really, there's not much left of it, and that is very sad. for me. I knew and respected Paul Volcker. He was a mentor and a friend. I think he was right to want to prohibit risky proprietary trading by institutions that had access to the safety net, FDIC insurance, access to the Fed lending facilities, and we don't want them engaged in high risk activities, and to let them get back into those risky activities at the same time we're weakening capital requirements is just an invitation for disaster. I mean, that's what got us into trouble during the great financial crisis. Big Wall Street banks taking highly leveraged bets on really risky securities and derivatives related to mortgages. That's what got us into trouble. And they were doing that on the government's dime. So we don't want to go back to that system. And I think the Volcker Rule also underscores the fundamental question of how broad do we want the safety net to be? Do we want deposit insurance and Fed lending to be supporting these risky Wall Street activities? Traditionally, we have not done that. We've supported bread and butter lending, taking deposits, making loans. That's what households and small businesses in particular need. That's where they get their credit. They can't access the debt markets. So we've traditionally supported that type of activity, but not Wall Street risk taking. But again, those barriers are being broken down now. And I do worry. I worry about expanding the safety net. That concern may seem quaint right now because of the massive support the Fed's been providing, especially in the corporate debt market. So maybe I'm quaint and old fashioned and worrying about market discipline, but I do still care about it. And it concerns me that corporate debt markets now, they're wide open to just about anybody's investment grade or was investment grade prior to the pandemic. And that is because the Fed, of course, has committed to backstop these programs to make pretty much unlimited investments in investment grade debt, or even the junk stuff. If it's in ETFs, they're also buying ETFs as well. So that's maybe that's necessary, maybe it's not. Given the severity of the pandemic, obviously intervention was needed, but I don't think these choices are binary. And this was an issue during the 2008 financial crisis. It seemed like the choices were, go all in or don't do anything. And those were not the choices. There were spectrums of options. There was a spectrum of options to take. And when government intervenes, I think they should try to be tailored and surgical about it. It's we want a market-based system. We don't want the government jumping in every time there's a problem and bailing out those who have taken risk and saving them from their own mistakes. So it reminds me of a situation I was confronted with during the Great Financial Crisis. The Treasury and the Fed actually asked me, the FDIC, to backstop all liabilities of all financial institutions, even the holding companies, not just insured banks, going up to these large banking organizations, the thrift organizations. $14 trillion, I said no. I didn't think we were capable of doing that. I didn't think we needed to do that. And what we ended up doing was coming back with a much more limited proposal. If we had done that, it basically would have been a bailout of bond investors, right? But those investors, they'd already bought the bonds. They were stuck. That wasn't where the market disruptions were. The problem was with the ability of financial institutions to roll expiring debt. They become too reliant on debt. They become too reliant on short-term debt. They were having problems rolling that debt as it expired to keep access to funding. So we did a more limited program designed just for newly issued debt. We set a cap on it. We charged a premium for it. And actually the program worked very well. And it seems to me that the Fed had a similar choice in intervening with the corporate debt markets. I supported their intervention when this thing started. I saw all of these companies that were, barely investment grade. I was worried about them immediately falling into junk territory with this terrible pandemic and the economic damage it was causing, not being able to access credit, having to do wide-scale, layoffs because they could no longer fund themselves. So I supported intervention. But it seemed to me where the Fed should have been intervening was, again, with the primary issuance, again, helping those corporations issue new debt to continue their funding to replace expiring debt. But the primary emphasis has been in propping up the secondary market, which, of course, has helped bond investors. But that's not where the problem was. The problem, at least I think, for the real economy that we wanted to address was to make sure that companies had the access to funds to maintain operations. And I also think those debt purchases should have been accompanied by restrictions on distributing any capital to shareholders or excessive bonuses or executive compensation. You wanted to keep that government support, the funding being provided by that government support, into operations, supporting payroll. That's what the economy needs. So again, we're there, and Actually, the primary market has opened up through the Fed's secondary market interventions, and that's a good thing. But why are we bailing out all these bond investors? That doesn't make any sense to me. And again, no strings attached, no limitations to make sure that funding support is going into operations and payroll. So the safety net really has been stretched to the limit to support capital markets. Maybe not so much for Main Street, but it is what it is. And I think we're losing market discipline. We're expanding the safety net dramatically. And I worry that market discipline is going to become a thing of the past. And that's going to be very, very bad for financial stability because, government can't do it all. Let's talk again specifically about the financial sector. Government can't do it all. Even with a great law like Dodd-Frank, even with the, regulators don't always do what they're supposed to do. And regulators can get captured. Republicans get captured. Democrats get captured. It's not corrupt. It's just the ability of regulators the tendency to start thinking like the institutions that they regulate instead of thinking more broadly about system stability and public protection. And this is a bipartisan problem. This deregulation, it started with Mr. Greenspan, but it really reached its apex during the Clinton years when we repealed Glass-Steagall, when we, took derivatives markets pretty much out of anybody's regulatory ambit. That's been fixed now, thank goodness. But it's just to show that it is bipartisan. So we need some hard guardrails around regulatory discretion. And if you look what's going on now, I think, again, that underscores the point. So regulators now, well-intentioned regulators, I know a lot of them, they're good people. I don't question people's motives, but I think they're very misguided because they're weakening the rules. They're celebrating all the capital the banks had going into this because of Dodd-Frank and the efforts of a lot of people that predated them. But then they're weakening the very framework that led to those much higher capital levels. And they're doing it in a way that's not really transparent. They're adding to complexity. They're making it harder to understand the true impact of their actions. They're saying, and I take this at face value, that they're just trying to improve and simplify and streamline and make sure that access is flowing now with this pandemic. But if you look at what's going on, it's kind of the opposite. So let's just go down the list, for instance. So they weakened the stress test assumptions, and Lael Brainerd, good for her, she voted against that. That would have reduced capital minimums by about $100 billion. They weakened the leverage ratio. That would have will reduce eventually capital minimums by about $76 billion at the holding company level, $55 billion at the bank level. They've eliminated inter-affiliate initial margin requirements for insured banks. That's $55 billion that will now be able to leave insured banks. That was there before to protect them against derivatives exposures of their affiliates. They've been loosening capital rules at the same time. They're letting banks and bank holding companies pay dividend. FDIC insured banks distributed $30 billion in capital and dividends to the holding companies in the first quarter. Most of that was distributed on to shareholders. And then there's still a pending proposal. It hasn't been finalized, and I hope it does then. But it would reduce what's called the enhanced supplementary leverage ratio, which is a very key constraint on excessive leverage. For the 8 largest banks, this proposal will reduce their capital, their minimums on average by 20% or about $120 billion. So these are big numbers, and nobody's really explained the cumulative impact of all this. I'm sure there's some overlap, but it would be nice to know, but I can only assume these are big numbers. This is a substantial reduction in capital minimums. Personnel is policy. That's just at the end of the day, that's what it is. And the best thing we can do to protect the public from financial instability is to appoint regulators and encourage regulators to have the know-how and the willingness to see through self-serving rhetoric of industry lobbyists. Banks have a point of view. Banks, they're trying to maximize ROE. They're publicly traded, for-profit entities. Their lobbyists, their executives are all big shareholders too. They want to maximize their returns. Fine, good for them, but that's not government's objective. That's not the regulators' objectives. There's a tension between the two. We want to promote financial stability. We want to protect the public from financial instability. And so we need regulators that understand there's a tension. They need to be independent. They need to be skeptical of every line that a bank lobbyist gives them, and they need to listen to other people like the folks at Better Markets who have a very different point of view. And we do need guardrails around regulatory discretion. We need some floor. That's what the Collins Amendment was all about in Dodd-Frank, to set a floor wherein regulators could not lower capital below that floor. And we did that because you look at what happened in the run-up to the Great Financial Crisis. It was ridiculous how much leverage regulators were allowing. The rules allowed this amount of leverage, and regulators were saying it's fine. If the banks know how to manage their risk, they can deal with this much leverage. So we need the Collins Amendment. The Collins Amendment is now under attack. I worry about the bank lobbyists trying to gut it as part of the next stimulus package. And again, that's another battle I hope Better Markets can help fight, because I think the Collins Amendment is really important. We need to keep it. We need to keep capital. And we need to let banks keep failing, right? But we need to let them fail. We didn't let them fail during the Great Financial Crisis. Most of them we didn't. We need to let them fail this time. We need market discipline. There are new tools in Dodd-Frank that will allow banks to fail and give the regulators tools to manage that failure, to protect the broader public. Those are tools that we didn't have during the Great Financial Crisis. And regulators need to be prepared to use them, because I do worry all this, the regulatory easing capital rules, at the same time you're allowing dividends to be paid to shareholders. If these banks get in trouble later, or regulators feel, the desire to do bailouts to save face or whatever, I do worry that could be a dynamic, and I hope that doesn't happen, because we need market discipline. And if banks have taken on too much leverage, they've released too much capital, they don't have the balance sheet to absorb their losses, then they need to accept responsibility for that. And finally, I think we need, as I said, strong markets. We need market discipline, strong regulations, strong regulators, but most of all, we need organizations like Better Markets. Better Markets does such a good job. They tirelessly monitor and track this overly complex web of financial regulations that we have. They sort through that morass. They've got lots of experts on the staff. They help translate it for the public. They help keep regulators honest. And that's what we need to do. But their job, and our job, everybody's job, would be so much easier if these rules could be simpler and more transparent, so they could easily be grasped by the public and media. So there's a lot of good work that went into implementing DFA. A lot of it made the banking system much stronger going into this. It's being undone right now, a lot of it in the name of pandemic relief. No matter how well-intentioned, this is directionally absolutely the wrong way for the regulators to go. The next administration will need to change course. Fortunately, most of Dodd-Frank remains intact. The tools are there to make sure we have a resilient system. The tools are there, and with the right regulators, I know we can get the job done. So thanks very, very much for having me today. Again, congratulations to Dodd-Frank. Congratulations to Better Markets, and be well.
Hi, everyone. It's Mike Masters. I'm chairman of the board of Better Markets, and that was great. Ms. Baer, thank you for sharing your experiences and insights on financial reform and the Dodd-Frank Act and the subsequent period. It's now my pleasure to introduce our next speaker, Sarah Bloom Raskin, who has had a long and distinguished career as a public servant. She's been an attorney, a consumer advocate, regulator, and a senior government official. In 2014, she became the Deputy Secretary of the Treasury in President Obama's administration and made history as the highest-ranking woman in the history of the Treasury Department. For those of you who don't know, it was founded a mere 225 years ago in 1789. As the second in command of Treasury, Deputy Secretary Raskin oversaw the various agencies of the entire department and promoted innovative policy solutions to advance prosperity, fairness, and resiliency throughout the economy. And that resiliency is especially important today. Prior to her service at Treasury, she was governor of the Federal Reserve Board from 2010 to 2014. At the Fed, she conducted the nation's monetary policy as a member of the Federal Open Market Committee, directly regulated banks, monitored threats to the nation's financial stability, and oversaw the nation's payment systems. In addition, she focused on consumer protection and income inequality. Prior to that, she served as Maryland's Commissioner of Financial Regulation from 2007 to 2010 as the subprime mortgage bubble and financial crisis exploded. She saw firsthand the importance of banking to Main Street families, but also the dangers of predatory behavior. She focused on foreclosure artists, payday lenders, and debt collection firms, among others, and her tenure provided her with a kitchen table, community-based understanding of the importance of finance and fairness to everyone working hard to achieve the American dream. Mrs. Raskin is currently a Rubenstein Fellow at Duke University, where she works closely with the Rethinking Regulation program and the Global Financial Market Center to improve the public's understanding of markets and regulation. She's also been a visitor at the Stanford Graduate School of Business, Corporations and Society Initiative, and a distinguished visiting professor at the University of Maryland's Curie School of Law. She chairs the board of IX Investments, a social impact investing firm, serves on the board of Vanguard Group, and also serves as a trustee of Amherst College and Folger Shakespeare Library. Ladies and gentlemen, please join me in welcoming Sarah Bloom-Rasky.
Well, thank you, Mike, for that kind introduction, and welcome to the virtual audience, all the good people assembled on this anniversary day. It's a pleasure to join you and add my perspective on Dodd-Frank and what happened after it was signed by President Obama and made its way to the regulatory agencies for implementation. So here's how I'm going to do this. I'm going to provide a reminder, and I'm going to describe then 3 necessary shifts that were ushered in by Dodd-Frank. So the reminder is this: statutes need to be implemented by agencies in order to work. Statutes need to be enforced by agencies in order to be trusted and meaningful. Statutes are only as good as the manner in which they are executed. This is true of most federal law, but it had a surpassing importance when it came to a statute as significant and far-ranging as Dodd-Frank. So first, I want to give us all a big dose of the reminder of careful, timely implementation and enforcement by agencies. Then I'll describe 3 necessary shifts that Dodd-Frank ushered in. First, Dodd-Frank expanded our notions of why financial guardrails matter. Out were the false choices that protections for consumers and for households and clear expectations for banks were detrimental to prosperity. In was the notion that prosperity that sets appropriate expectations for financial firms. The second necessary shift that I'll describe is like this. Dodd-Frank attempted to foster preparedness and prevention as a way of reducing the costs of fighting economic crises and restoring prosperity. Dodd-Frank taught us that denial is more expensive than facing reality. And the third necessary shift of Dodd-Frank was its drawing into policymaking new voices, new perspectives, leading to a galvanizing creativity in thinking about our structural problems and how best to address them. So back to the reminder, the fact that a statute is only as good as its implementation by agencies. The financial crisis that led to the Great Recession revealed cracks in the world of finance, cracks in the world of banks and financial institutions, and cracks in the world of the regulators who oversee financial practices. And these cracks in our financial system and in our regulatory structure allowed a terrible crisis to pour in, a crisis that drowned the economic well-being of homeowners and their families, wiped out their jobs, and drained the value of their homes and their retirement assets. Dodd-Frank was the legislative equivalent of a job of spackling, patch up, sanding down, polishing, and painting. The structural weaknesses exposed in the financial crisis were significant. We saw failures in financial firms' internal controls, problems in new and derivative financial instruments, weaknesses in job security, breakdowns in consumer protections, basic dysfunction in housing markets, systemic defects in regulatory oversight, decrepit enforcement, broken guardrails for appropriate corporate behaviors, and erosion of household financial security, brought about by decades of profound and growing income and wealth inequality and systemic racism. In the face of these converging structural weaknesses, Congress enacted comprehensive structural reform of the financial system and the regulatory regime. Passage of Dodd-Frank was a crucial start at structural reform, but it was just a start because, of course, it still needed to be implemented. To effectuate Congress's vision set forth in the more than 1,000 pages of federal statute required significant interagency coordination of a nature unmatched in the legislative docket of the Obama administration, with the exception perhaps of the Affordable Care Act. No sooner had the ink of President Obama's pen dried on the legislation's page than the clock of implementation began to run. The statute became property of the agencies that had to breathe air into all the statutory directives. Rules had to be written by the Federal Reserve, the Securities and Exchange Commission, the Commodities Futures Trading Commission, the FDIC, the Comptroller of the Currency, the National Credit Union Administration. Stress tests had to be designed, constructed, communicated, and performed. The contours of living wills had to be drawn up. A new agency had to be built, the Consumer Financial Protection Bureau, and parts of its foundation had to be carved out of the existing agencies. An agency had to be eliminated, the Office of Thrift Supervision. Exercises with global counterparts had to be arranged and performed. A new coordination mechanism had to be built, the Financial Stability Oversight Council, and expertise for systemic risk needed to be drawn into public service and nurtured. A centralized repository of financial information needed to be developed, the Office of Financial Research. The templates for revised reporting by banks needed to be developed. Rules with auditors needed descriptions. On-site examination manuals and expectations needed updates. Mortgage servicers needed to know the criteria by which they would be evaluated. Homeowners needed to know whether they would qualify for a modification of the terms of their mortgages. And that is all just a start. The list here is just suggestive and hardly comprehensive. At one point in late 2010, the list at the Fed of items to be done pursuant to the new law was upwards of 900, and this was just one agency. The FDIC had its list, the OCC had its, Treasury tried to keep a master list, the CFTC had its list, the SEC had its, and these lists had keepers and managers and so-called czars and teams of people whose job it was to keep to the deadlines that the statute had imposed. Coordinate also with the other agencies, assemble the appropriate internal expertise within the agencies, reach out to external expertise when necessary, and regularly report to Congress on whether the deadlines had been achieved and whether progress, provision by provision, was being made. This was part of the price we paid for decades of ignoring the cracks in our financial system. The work to effectuate Dodd-Frank was massive and pulled from the people who were needed in this effort some of the best leadership I have ever witnessed to perform the repair and reform that Congress had directed. This extraordinary undertaking is what government means. And if it's to be done well and reflect the will of Congress and the American people, it requires an investment in broad and deep talent. Now, to be fair, Dodd-Frank and its implementation for structural reform was in certain respects incomplete, late, flawed in some ways. There are provisions that to this day have not been implemented. We've also learned that the sustainability and resilience of the reforms depend on the experience and perspectives of the policymakers at the agencies. Dodd-Frank came under assault and re-assault, and many of the battles that Congress fought to bring it forth into law were refought in the agencies. And still, a full decade later, it is worth our admiration and appreciation for what it ushered in. First, the necessary shift that it introduced in terms of policy. Dodd-Frank expanded our notions of why financial guardrails matter. In the early days of the crisis, at around the time of the Lehman Brothers failure, many Americans didn't understand the causes of what had occurred. There was something esoteric about finance, about derivatives, about regulating banks, about mortgages, in fact, what banks even do, about how the stock market acts, and most certainly about what the Federal Reserve does in both good times and bad times. Finance was an afterthought to most people's lives and sense of well-being. What happened on Wall Street stayed on Wall Street, if you asked any American in 2006. People interacted with their banks, if they had one, to get mortgages and a checking account, but that was about it. There were obvious problems developing locally when mortgages morphed from being their usual fixed vanilla selves into something with many new flavors, with terms that became confusing and mind-numbing in their complexity. And when people of color became steered into particular types of these new flavors, essentially those with prepayment penalties and hidden higher costs, predatory practices and the riskiness of the mortgage market came to the fore. But the possibility that predatory practices fueled by the behavior of the creators and holders of particular financial instruments could lead to a foreclosure crisis marked by job loss, home loss, and prolonged economic downturn across the country and the world wasn't being addressed. It was only after the dramatic days of the Lehman failure, but before Dodd-Frank was signed into law, that a growing sense among Americans developed that the economic collapse and costs associated with job losses and home losses and wealth losses was far more significant and personal and relevant than had previously been imagined. The performance of banks and financial firms mattered. Oversight of banks mattered. Consumer protections against predatory practices and debt traps and confusing terms mattered. Losing homes and jobs hits people hard, and these losses became a hallmark of the financial crisis. In a way, the risks of finance run amok had been shifted to the shoulders of households that now had to bear the pain. And it was this moment, too, where we saw the emergence of Occupy Wall Street, Too Big to Fail, Too Big to Jail, movements representative of the personal way in which the financial crisis was experienced by many Americans, and movements with political consequences. Americans cared about banks and financial policy. They understood guardrails on bank behavior and the importance of swift enforcements against bad behaviors. Their understanding of banking had enlarged. There was a shift in the wind. Before Dodd-Frank, federal financial regulation was an activity that might not have mattered to the well-being of most Americans. After Dodd-Frank, there was a greater appreciation for the ways in which there were direct consequences between regulatory safeguards and economic well-being. Specific regulatory safeguards could affect your ability to pay your mortgage, your ability to hold your job, your ability to keep your house. Dodd-Frank launched financial regulation in a direction that encompassed a broader understanding of public effects on household confidence, well-being, anxiety, and community prosperity. Dodd-Frank thrust policymakers into understanding that the economy is only as good as its homeowners and consumers are, that economic growth and justice depend on the confidence that consumers have in oversight and swift and even-handed enforcement. And then without confidence, there's no business investment, no innovation, no consumer demand, no justice, no prosperity. As Dodd-Frank came to be implemented, dependence on housing as a form of wealth when labor compensation is flat and dwindling became more understood. Income and wealth inequality became better understood. The costs in waiting for a crisis as compared to the cost of being prepared, the role that racial discrimination plays in holding back inclusive economic prosperity, all became matters more fully understood. And so emerged the everyone economy. Dodd-Frank was the start at bringing us a vision of the everyone economy, a place where there is a much vaster appreciation of the ingredients of the importance of an economy that works for more than the few. Not only did the ingredients of economic success become more fundamentally appreciated, but the need for preparedness became understood. This was the second necessary shift ushered in by Dodd-Frank. The costs of the financial crisis were enormous, and had the relevant policymakers been better prepared to address risks that had emerged in the decade prior to the crisis, then perhaps these costs, the job losses, the home losses, the loss in economic opportunity, could have been minimized. The tools and rules devised by Dodd-Frank were attempts to foster a thinking ahead on the risk horizon, an attempt to be better prepared, to have the hole in the roof fixed before the entire roof caved in. Think of the stress test requirement as an example of a proactive tool that was meant to keep banks well capitalized and appropriately buffered against a shock of the financial crash's magnitude. Think of the requirement of ability to pay, an intuitively appealing notion that banks use when extending loans to borrowers, but also meant as a preparatory tool that could mitigate against the effect of shocks. This theme of preparation, supported by the experience of having witnessed denial as an expensive proposition, carried over in the institutional habits of coordination that Dodd-Frank required. While before Dodd-Frank, the fragmented nature of regulatory oversight created the problem that systemic risk could emerge in the cracks between the agency's formal jurisdictional limits. After Dodd-Frank, there was a greater premium and necessity put on interagency coordination. Most rules that Dodd-Frank required be written had to be joint, meaning that the agencies like the Fed and the SEC needed to coordinate, to talk to each other regularly. At the same time that agencies had to talk to each other in order to get the rules required by the law out in time, there was a recognition that better processes could be developed by creating a forum, a regular forum for the discussion of emerging risks. This recognition was in part the reason for the creation of the Financial Stability Oversight Council, the body of federal financial agency heads chaired by the Secretary of the Treasury that would meet regularly, face to face, in an effort to identify and mitigate emerging risks that could be developing in the cracks between their agencies' formal jurisdictions. So Dodd-Frank required coordination, a necessary step forward from the days of agency isolation. And these requirements grew into habits, good habits, that encouraged the early sharing of developments and information. Finally, let me say and end by describing the third necessary shift that Dodd-Frank galvanized. And that was and is the energizing of a group of new people with new ideas that connected finance to society. The explosion of these ideas and the new people from various fields, not just economics and math, but sociology and political science and philosophy, there were new people that began studying and explaining under what conditions finance enhances societal well-being. There were activists and think tanks that fostered these inquiries and teachers who began to incorporate these ideas into their courses, All of this thought and illumination were an important and sometimes underappreciated institutional legacy of Dodd-Frank. More people with more varied backgrounds wanted to work on the implementation efforts at the Federal Reserve and Treasury and the agencies, and some of them had been touched by the financial crisis or lived in communities that had. Like a magnet, the structural fixes that the statute required pulled into public service people who wanted to participate on the ground effort. People wanted to apply their particular kinds of expertise and perspective to the collaborative and exciting efforts that were shaping the way the economy was being reformed, restructured, and ultimately reimagined. A shift in the wind had happened. After Dodd-Frank was signed, changes occurred in the policies, the processes, and the people that infused discussions about structural weaknesses in need of repair. Embedded into the project that Dodd-Frank represented was a sense that government was a force for good, a force to be trusted, a force where imaginative and new thinking could rise to the occasion to create something better and stronger, an economy that perhaps could work for all. And on this, the 10th anniversary of Dodd-Frank, poised as we are in the midst of another crisis, and being clear-eyed, too, about the incompleteness of a necessary project of repair that Dodd-Frank represents, there seems almost nothing better at this moment than being given the chance to savor and appreciate the bounty that this statute gave us. Thank you for your interest, and thank you to Better Markets and, of course, the George Washington University Law School for hosting this event.
Thank you, Sarah. That was great, and thanks for sharing those unique historical and perspectives and thoughts. You've certainly given us a lot to think about. The same will be true of our next speaker, no doubt. She is another one of the guests today that really needs no introduction. I'm going to tell you a little bit about Chairwoman Maxine Waters before she makes her remarks. Considered by many to be one of the most powerful women in American politics today, she has gained a reputation as a fearless and outspoken advocate for women, children, people of color, and the poor. No matter where she is or what she is doing, you can be sure she is thinking about and fighting for the most important values of fairness, equality, dignity, respect, and speaking truth to power. Everyone who's ever met her or knows her work can see her passion and commitment. That's why Chair Waters was elected in November 2018 to her 15th term in the U.S. House of Representatives with more than 70% of the vote in the 43rd Congressional District of California. In January of 19, Congressman Waters made history as the first woman and first African American chair of the powerful House Financial Services Committee. Her priorities and values were reflected in the work of the committee, which she reorganized upon being the chair, including establishing a subcommittee on diversity and inclusion, as well as one focused on oversight and investigation. Under her leadership, the committee is now firmly on the side of consumers, investors, and Main Street families who need a banking system that supports them. She has also led the charge for accountability of the financial services industry and those who are supposed to regulate it and enforce the law without fear or favor. Before becoming chair, Congressman Waters was the ranking member of the committee since 2013. In that capacity, she was a steadfast and very effective defender of the Dodd-Frank Act, which at the time was under relentless attacks by many seeking to weaken or kill it. And at the same time, she was proposing additional financial reforms to protect America's workers, consumers, and investors. Prior to that, she focused on robust financial reform and was a leader in the efforts that ultimately resulted in the Dodd-Frank Act. She's also led congressional efforts to mitigate foreclosures and keep American families in their homes during the housing and economic crises, notably through her prior role as the chairwoman of the Subcommittee on Housing and Community Opportunity. She also authored the Neighborhood Stabilization Program, which provides grants to states, local governments, and nonprofits to fight foreclosures, home abandonment, and blight, and to restore neighborhoods. An integral member of the Congressional Democratic leadership, Congressman Waters serves as member of the Steering and Policy Committee and is the co-chair of the Bipartisan Congressional Task Force on Alzheimer's. She is also a member of the Congressional Progressive Caucus and a member of the past chair of the Congressional Black Caucus. Finally, I'm speaking from the city of Atlanta, Georgia, which is the home of former Congressman John Lewis. And I know that you worked with him for many, many years. And just wanted to say that we certainly, coming from Atlanta, we will all miss him very much and his work. And so now we'd like to welcome you to our forum. Thank you for speaking to us.
Thank you very much, and thank you for that very generous introduction. I am so pleased and delighted that I was asked to participate today in the 10th anniversary of Dodd-Frank. As you know, this legislation is a serious part of my career and legislation that I consider has done the very most for consumers in any Congress that has ever attempted to deal with the issues of the financial services community. So I'm very pleased to join you for this event celebrating this 10th anniversary of the Dodd-Frank Wall Street Reform and Consumer Protection Act. I would like to thank Better Markets, President and CEO Dennis Kelleher, for inviting me to speak to you today, and Better Markets Chairman, of course, Michael Masters, for that introduction. I'm very proud of the work that my colleagues and I did to pass the Dodd-Frank Act following the global financial crisis of 2008. At that time, millions of families had lost their homes to foreclosures driven by unregulated, abusive, predatory lending. The catastrophic Great Recession also resulted in trillions of dollars in lost wealth and massive job losses. In Congress, Democrats took decisive action to ensure that consumers, investors, and the economy would be better protected from a future crisis. This landmark law made significant reforms on a wide range of policy fronts, including creating the Financial Stability Oversight Council, that is FSOC, and enhancing prudential standards for the largest financial institutions to impose robust capital, liquidity, leverage, stress testing, and living will requirements. Dodd-Frank also cracked down on risky speculative trading by establishing the Volcker Rule and created a new regulatory regime for the previously unregulated derivatives market. And importantly, we reformed the mortgage market and eliminated certain predatory products. At the centerpiece of the law, we established the Consumer Financial Protection Bureau to ensure that consumers would have an independent watchdog to protect them from abusive financial products and practices. Under Democratic leadership, the Consumer Bureau was widely successful, putting millions of dollars back in the pockets of hardworking consumers who had been ripped off and stopping many abusive acts by financial institutions. But despite all of these successes, there are those who still want to return to the bad old days where consumers did not have a watchdog looking out for them and predatory lending was allowed unchecked. I became the ranking member of the Financial Services Committee following Barney Frank's retirement. As such, the baton of Chief Defender of Dodd-Frank fell to me. Jeb Hinterland was chairman of the committee, and he was committed to rolling back as much of Dodd-Frank as possible. He held many hearings claiming Dodd-Frank was hurting businesses and Wall Street. He refused to hear the testimony of the CFPB director. He passed dozens of bills through the committee to gut Dodd-Frank. He did everything he could to undermine, eliminate, and roll back Dodd-Frank. The Democrats on the committee and I were the last line of defense. We took that responsibility seriously. We fought back in hearings, we challenged him in markups, and we tried to be united on the floor. We were never more united than when Hinterland tried to pass what we called the Wrong Choice Act, a bill that would have paved the way back to the financial crisis. The legislation, which was Hinterland's signature bill, would have functionally terminated the Consumer Bureau, weakened important financial stability safeguards, and repealed the Orderly Liquidation Authority, which is the mechanism we put in place in Dodd-Frank to prevent future bailouts and ensure that large financial institutions can fail safely, among other harmful provisions. Later that year, the voters of this country spoke out and demanded a change in leadership in the House of Representatives. When Democrats took over, I made it clear that the committee's days of weakening regulations and putting our economy at risk of a financial crisis were over. Shortly after I said that, bank shares fell by 0.6%. Wall Street knew that I meant business. As the chairwoman of the House Financial Services Committee, I'm at the forefront of not only protecting the important reforms we put in place in Dodd-Frank, but also of improving upon the law to provide additional protection for consumers. President Trump promised to do, quote, a big number on Dodd-Frank in his first few days in office, and I'm proud to say that that hasn't happened on my watch. Under my leadership, the deregulatory bills that made the committee known as, quote, the Juice Committee, in which special interests drafted legislation directly for members, are now dead on arrival in the House of Representatives. Instead, we have focused on supporting and protecting consumers, investors, and the economy. My leadership of the committee is historic. I am the first woman and the first person of color to ever wield the gavel in the Financial Services Committee. However, my leadership of the committee is also historic because of the important legislation we have moved to push back against Trump's attempts to unravel Dodd-Frank Act and the legislation we have passed to improve upon Dodd-Frank and to expand consumer protections. Trump's political appointees to the Consumer Bureau have worked hard to rewrite the strong consumer protection regulations finalized by former Director Cordray. And the Trump administration has also worked to compromise the agency's independent structure. It is for that reason last year that I advanced legislation called the Consumers First Act, that is H.R. 1500, to block the Trump administration's anti-consumer agenda and reverse their efforts to undermine the mission of the Consumer Bureau. The legislation, which passed the House in May of 2019, reverses many of the structural reforms Trump appointees have made to undermine the CFPB, including restoring the Office of Fair Lending and Equal Opportunity, limiting the number of political appointees at the agency, directing the Consumer Bureau to promptly resume Military Lending Act exams after Mulvaney stopped the agency from supervising its regulated entities for compliance with the Military Lending Act, and requiring that the agency's helpful consumer complaint database remains publicly accessible, so there is transparency about the concerns consumers face every day in the financial marketplace. Under my leadership, the Financial Services Committee has also conducted rigorous oversight of Trump appointees to the financial regulatory agencies, including the Consumer Bureau. For example, last year, following an extensive committee investigation, we released a majority staff report entitled Settling for Nothing: How Kraninger's CFPB Leaves Consumers High and Dry. The report presented evidence that the Trump administration's politicization of the Consumer Bureau has led to a decline in the Consumer Bureau's redress for harmed consumers in enforcement actions. The committee has also highlighted the consumer abuses that arise from payday lending, rent-a-bank schemes, and other predatory forms of lending. And we have fought every effort by Director Clevenger and other Trump appointees who have sought to relax key consumer safeguards. I've also worked to pass legislation to provide additional consumer protections, including by advancing H.R. 3621, the Consumer Credit Act, sponsored by Representative Presley, and containing bills also sponsored by Representatives Adams, Beatty, Lawson, Lynch, and Tlaib, to make essential comprehensive reforms to the nation's broken consumer credit reporting system, which passed the House in January 2020. Last month, the House also passed bipartisan legislation sponsored by Representative Gottheimer, H.R. 5332, the Protecting Your Credit Score Act, to provide easier access and stronger protections for consumers in our credit reporting system. So I want to bring up the fact that I created something called OMWIS in Dodd-Frank and the D&I subcommittee. I'm particularly proud of my contributions to Section 342 of the Dodd-Frank Act, which required most of the federal financial agencies' services and each of the Federal Reserve banks to establish offices of minority and women inclusion, known as, again, OMWIS. OMWIS are designed to, among other things, collect and report on diversity data from their regulated entities, thereby holding them accountable for diversity and inclusion results. In addition to the creation of the OMWIS, I have continued to create accountability for diversity and inclusion. One of my very first acts as chairwoman was to create a historic subcommittee on diversity and inclusion. Through this subcommittee, we've held hearings on the lack of representation of women and minorities in the financial sector, board diversity, the racial and gender wealth gap, diverse asset management, the lack of diversity in America's largest banks, among many other important topics. We have also passed strong diversity legislation, including bills to require companies to disclose the demographics of their boards and C-suite executives, and to require Federal Reserve banks to consider diverse candidates when filling bank president vacancies. Subcommittee Chair Beatty and I released a staff report on bank diversity data, making further recommendations on why banks and others must make diversity and inclusion a priority in their employment pipeline, on their boards and with suppliers. The Dodd-Frank Act set the stage, and I'm continuing to work for the inclusion of women and people of color, especially in the midst of this pandemic that has been shown to be more disproportionate to affect them. And so in the early weeks of the pandemic crisis, I convened a call with members of the committee and the CEOs of our nation's largest banks to question them about their response to the pandemic. On that call, we repeatedly heard from the CEOs. We repeatedly heard from them that Dodd-Frank's enhanced potential standards had put them in a strong position to weather this pandemic, provide forbearance, and continue serving their customers. These comments at a moment of crisis reaffirm that Dodd-Frank has served a critical purpose in making our financial system stronger and providing stability when times get tough. That represents real progress, and it bolsters my resolve to fight deregulatory efforts to roll back these safeguards. I'm now focused on making sure that the mistakes of the last crisis and recovery are not repeated. Leading into the 2008 crisis, communities of color were targeted with and steered into predatory loans, with Black and Latinx families disproportionately losing their homes to foreclosure. We're now seeing the disproportionate impact that this coronavirus crisis is having on communities of color, both on the health front and economic fronts. During this unprecedented crisis, it is critical for Congress to recognize that the focus should be on both providing and ensuring equal access to relief. I am working with my colleagues in Congress to not only provide relief to consumers, but we're also focusing on how to ensure that communities of color and low-income communities have access to new and existing relief efforts. For example, in addition to passing unprecedented legislation to respond to the pandemic, my committee has repeatedly convened virtual meetings and calls with both the chairman of the Fed and Treasury Secretary to urge administrative changes so that programs like the Paycheck Protection Program and Main Street Lending Facility are open and accessible to minority-owned businesses. And we have been successful, including securing set-asides for community lenders who cater to communities of color. In the 2008 crisis, financial institutions got bailouts, but millions of families on Main Street lost everything through no fault of their own. Unfortunately, we're again on the precipice of economic disaster. We're now seeing a situation in this pandemic crisis where the stock market has recovered its initial losses, largely because of the Fed's efforts to pump in trillions of dollars to the markets. But families across the country are suffering, again, through no fault of their own. Fully half of Americans are not working. 1/3 of renters could not pay rent in July, and nearly 1/10 of homeowners have received forbearance. Nevertheless, the initial protections put in place in March, unemployment insurance, eviction and foreclosure moratoriums, and economic stimulus payments are expiring or have been spent. Families everywhere need immediate help. And my committee and House Democrats are deeply committed to making sure that Congress takes action to provide additional relief to families and prevent a wave of evictions, foreclosures, and economic suffering. So I want to thank you again for inviting me to discuss Dodd-Frank on the 10th anniversary of the law. As chairwoman of the Financial Services Committee, I'm working every day to make sure that the reforms that we enacted in Dodd-Frank are not weakened and that consumers, investors, and the economy are protected. I cannot end my comments with you today without thanking Barney Frank. Barney Frank served as one of the greatest leaders of this Congress, and I consider him as having mentored me. Without Barney Frank, I don't think I ever would have become the chair of the Financial Services Committee. I learned more in the time that I worked with him than I've learned on any other subject in my life. And I'm thankful to Barney for that. So thank you all again for inviting me.
Thank you, Chair Waters, for those remarks. And frankly, we're all very thankful to Barney Frank for being in our lives. Look, thank you for your years of relentlessly fighting for financial reform in Dodd-Frank and for your leadership in fighting to protect all Americans who need and use financial services, including the and underbanked who are often exploited and preyed upon. Now we've arrived at our closing keynote address from Senator Elizabeth Warren, who's going to talk about making government work for everyone, the Dodd-Frank Act, and the fight for the Financial Consumer Protection Bureau. Elizabeth Warren has been a senator from Massachusetts since 2013. She was reelected in 2018 and most recently was a Democratic candidate for the 2020 presidential election. She may not have won the nomination, but she certainly won the ideas race. Her substantive policies and original and innovative ideas addressing everything from education to healthcare and racial justice to finance will no doubt be the framework for many laws over the years to come. That won't surprise anyone who knows her. Long before she was a senator, she was fighting for hardworking Americans for decades as a legal scholar and a consumer advocate. She labored in the trenches as a law professor specializing in bankruptcy law. That work provided her with ground truth. The lives people lived, the struggles they have, the challenges they face, and how the financial and legal systems were working for them or against them. Those lives and stories resonated deeply with her. As she has said, quote, she grew up on the ragged edge of the middle class, close quote, meaning you worked hard, but you were living precariously when even a small setback could send you plunging into near poverty. That's why real people, often suffering at the hands of the law and the financial industry, were never far from her mind. Many of those people, decent, hardworking people, were put through the ringer of bankruptcy, often due to no fault of their own, because of medical bills caused by severe illness, unemployment, divorce, and injury. Many others were victims of financial predators. That's why she so well understands how the economic, financial, and legal systems not only work, but importantly, who they work for and who they do not work for and why. That's why she led the opposition to a bankruptcy law in the late 1990s and the early 2000s that was unfair to hardworking Main Street American families. That's also why she was such a powerful, passionate, and effective advocate for strong financial reform following the crash of 2008, and an influential voice throughout the Dodd-Frank Act debates. She also served as chair of the Congressional Oversight Panel for the $700 billion TARP bailout, which, although most people forget, was passed during the George W. Bush administration. She was the people's watchdog of both Wall Street and government officials, making sure that the taxpayers' money was well spent, properly used, and paid back. She's now taken all that experience and knowledge to the Senate Banking Committee, where she holds public officials, regulators, and bankers to account for their actions and pushing them to make sure that they are prioritizing Main Street families. She's passionate about making sure every American gets a fair shot at the American dream, not only the wealthy, powerful, and well-connected. And that's why most people describe her as fearless, because she is. It's my honor to introduce to you Senator Elizabeth Warren.
Thank you very much, Dennis, for that incredibly generous introduction. I'm so delighted to be here with you this evening to celebrate the 10th anniversary of the Dodd-Frank Act with Better Markets. You know, the fallout from the 1-2 punch of the pandemic and Republican efforts to deregulate our financial institutions has put our economy in great danger, which makes your watchdog efforts more important now than ever. Without the incredible work of Better Markets and all that it's been doing over the past decade, we would be in a very different place right now. So thank you for all you are doing. I am also especially grateful to mark this monumental achievement with President Obama, a man of courage and determination who embodies the very essence of moral leadership. I also want to offer a very special thank you to Congresswoman Maxine Waters for her tireless leadership in Congress and all across this country to protect and uplift the most vulnerable. And of course, a very special thank you to Chris Dodd and Barney Frank for their leadership that resulted in the laws that bring us here today. You know, 10 years ago, in the wake of the financial crisis, we were fighting to pass Dodd-Frank and to create the Consumer Financial Protection Bureau. Everyone here tonight knows what happened. But it is important that we never forget what brought us to this fight. Like so many of our nation's problems, the financial crisis was a toxic mix of racism, corruption, and shameless greed. Predatory mortgage lenders started by targeting Black and brown communities, where they began clawing away at the hard-earned wealth of Black and brown families. And too few people in power could be relied on to care. Not the investors who were making money hand over fist, not the regulators who were cozy with the banks, not the pundits who blamed the borrowers, and not the lenders who were boosting their profits. They didn't care because it was only happening in certain communities, communities of color. You know, imagine living in a community that had to overcome decades of housing discrimination and legalized racism. Imagine a community where homeownership opportunities were finally increasing and more people were starting to get their piece of the American dream. Imagine young people starting out, sometimes working 2 jobs to buy a home. Imagine working your entire life and building a solid retirement. Think about the power and the pride you'd feel knowing that your work had earned you a measure of security and something to pass on to your children and grandchildren. And now imagine having it stolen from you with no way to get back the life that you thought you were building. That's what the Great Recession felt like for so many working families. At its core, the financial crisis was a massive theft of power from millions of Americans, a massive theft of the American dream. In the crash of 2008, millions of people lost their jobs, millions lost their homes, and millions lost their savings. And maybe one of the most galling parts was that Wall Street mega banks, whose recklessness helped crash the economy, weren't ashamed. Nope. It was just the opposite. They took taxpayer handouts and then they turned around and doubled down with armies of lobbyists and lawyers trolling the halls of Capitol Hill, spending $1 million a day to bury Dodd-Frank and kill the Consumer Financial Protection Bureau before it was ever signed into law. The pundits all thought we were going to lose that fight. After all, the big banks had all the money in the world. But we had the people, and we got organized. Advocates jumped in, including unions and consumer groups whose first mission hadn't been consumer credit. Individuals who'd never been in politics, including me, were suddenly knee-deep in working on plans to get us out of the crisis. Now, we were blessed to have great leadership in the White House, with President Obama standing firm, even when some Democratic advisors were telling him, just throw the agency overboard. But President Obama did not fight alone. Vice President Joe Biden fought alongside him. He worked at it, calling on his relationships in Congress to help get a workable bill and pull it across the finish line. And we did it. With his help and the help of so many others, we made it through the Senate without a single vote to spare. Think about that. It was a real David versus Goliath moment. Even when the banks spent hundreds of millions of lobbying dollars, we won. For once, American families beat back the big banks. It was a critical moment for our economy, a moment to decide what kind of rules of the road we would have to protect families and prevent another crash. It was also a critical moment for our democracy. After years and years of Wall Street's running wild and calling all the shots, people could now plainly see that our elected leaders could and would act boldly on behalf of American families. We built a watchdog capable of looking out for middle-class families, a watchdog that could get rid of tricks and traps, a watchdog that could cut away reams of fine print that took away consumers' rights, a watchdog to hold financial institutions accountable when they break the law. Now, on the day that we won, Republicans and bank lobbyists declared it was only halftime. They said they would continue their war against the CFPB and their war against the American consumer. And they were true to their words. They did. Legislation to eliminate the CFPB has been introduced in the House and the Senate in every single Congress since the agency was created in 2011. Republicans have engaged in one harebrained scheme after another to try to undermine the agency's leadership. And despite the agency's track record of nonpartisan protection of consumers, and despite the agency's popularity, Republicans have targeted the CFPB's budget and sought to chop back its enforcement authority. But here's the thing. After years of industry attacks and GOP opposition, last month, the Supreme Court recognized what we knew all along. The CFPB and the law that created it are constitutional. The little agency is here to stay. So why have Republicans been so dead set against the CFPB? Why have they made repeal of the agency an act of faith? Well, I think deep down, they are threatened by the CFPB. Deep down threatened. And here's why. Donald Trump and Republicans are scared of the CFPB because they're buddies with the Wall Street banksters that the CFPB stands up to. Back in 2016, then candidate Trump made big promises to drain the swamp, ignore the lobbyists, and stand up to Wall Street. He lied. In fact, even before he set foot in the Oval Office, he filled his transition team and the incoming administration with lobbyists, special interests, and corporate insiders. As president, Trump has had so many bankers in his administration that Goldman Sachs could open up a new branch at 1600 Pennsylvania Avenue. Like, Donald Trump isn't going to drain the swamp. Donald Trump lives in the swamp. The Republicans fight the CFPB because their lobbyist buddies and bank insiders and corporate donors don't like it. But there's another reason that Donald Trump and the Republicans are scared of the CFPB. The CFPB is a roadmap for structural change, big structural change. The idea of a consumer agency was really pretty simple. A watchdog whose sole purpose would be to bark back at the financial institutions that built their business models, cheating American consumers. At the time of the 2008 crash, more than a dozen federal laws already addressed issues involving consumer credit. But the responsibility for enforcing those laws was spread out among 7 different agencies. 7. And here's what really kept me up at night. Each of those agencies could have shut down at least a part of the scam, but they all had some other first job. Not a single one of those agencies had as its primary job protecting consumers from dangerous credit products. Not one. The division of responsibility meant that credit regulation was a mess. It was an afterthought, and enforcement of the rules was spotty at best. We needed an agency, one agency, that would be responsible for making structural changes to the rules, for changing those rules as lenders change their practices, and for enforcing those rules. One agency that we could hold responsible when things went wrong. So together, we bent the levers of power in Washington to benefit working families over the wealthy and well-connected. We demonstrated a model that can be used to rewrite the rules of power all across our broken systems, a model for change that would work from our economy to our democracy to our public safety and justice system. Donald Trump and Republicans really can't stand Dodd-Frank and the CFPB because it shows that government can be a powerful force for good. Under the faithful and persistent leadership of Rich Cordry, the American people witnessed what's possible when government is designed to protect and serve the people. In 9 years of operation, the CFPB has delivered for American consumers. It's helped more than 26 million Americans directly. It has forced banks and financial institutions to return more than $12 billion directly to people they cheated. It's handled more than 2.2 million complaints. It's put in place common sense protections for American service members and vets. And the part that we can never quite measure is that over the past decade, millions of people have not been cheated because some financial outfit with some sleazy idea looked around and realized there's a watchdog out there that will bite. The creation of the CFPB teaches us that we can make government work, not just for the wealthy and well-connected, but we can make it work for everyone. Now, celebrations like this should happen more often. For almost a century, Democrats have fought for a government that works for everyone, and we've made some remarkable progress. Social Security, the minimum wage, Medicare, unemployment insurance, auto safety, the right to join a union, the FHA and the 30-year mortgage, the end of child labor, the 40-hour work week, health insurance through the Affordable Care Act exchanges for millions of Americans. And in 2010, we added the CFPB to the list of innovations that increased economic security and physical safety for hundreds of millions of people. Now, we haven't yet created a perfect union, but we have created more opportunity and more security for Americans, regardless of the color of their skin, where they were born, who they love, or how they worship. And where were the Republicans during all of this? Well, they were doing what they have done best for the better part of a century. They were saying no. Expand Social Security? Republicans said no. Raise the minimum wage? They said no way. The right to join a union? Republicans said you don't have one. FHA and the 30-year mortgage? They said no. The end of child labor? Republicans said no, that is socialism. The 40-hour work week? Republicans opposed it. Healthcare coverage for people with pre-existing conditions? Republicans said no, and they're still fighting that one in the courts today. No, no, no. When it comes to the well-being of the American people, the Republican Party has consistently been the party of no. The Republicans have chosen service to their corporate buddies and donors over service to the American people. The CFPB is just the latest, biggest structural addition to a long line of democratic innovations that help make America a stronger, fairer country. A long line of changes that have been brought into existence over the loud and incessant objections of the Republicans. So we're here tonight in remembrance of a brave and hard-fought and creative response to the 2008 crisis. But there's more. We are here tonight to celebrate how we have stood with our intellectual and political forebearers to use government as a force for good. We have much work ahead of us, and the path will be difficult. Much of the time, we will be fighting the Republicans and their wealthy donors, the party of no. But we will fight on because we know the America we are fighting for. An America where decisions in Washington are made with compassion, common sense, and moral clarity. An America where a run-in with law enforcement or a turn down the wrong street corner doesn't cost someone their life because of the color of their skin. An America where every working person, regardless of race, sex, or economic background, is paid a living wage. That's the America that we will create together when we beat Donald Trump, elect Joe Biden, and put Democrats in positions to make changes in 2021. We know this won't be an easy fight, but we don't take on this fight because it is easy. Nothing important ever is. We take on this fight because it is right. And if we stand together, if we fight together, if we persist together, we can build an America that works better for all of our families. Thank you, Dennis.
Well, thank you, Senator Warren. Your leadership, moral clarity, and courage on these key issues have made a difference in the lives of literally millions of Americans. And they know, and we know, no matter what else is going on in Washington, you're on the front lines, fearlessly fighting for them and their economic and financial well-being. the country is better off and well served by you every day. And thank you so much for not only your remarks, but your public service. Now, before I turn it over to Jeremy Pam, the director of George Washington Law's Business and Finance Law Program, for the closing remarks, I want to thank all of you for joining us, and for all of our speakers for taking time to come to join us today and for sharing their thoughts, especially President Obama, Senator Dodd, and Congressman Barney Frank. I also need to thank the Better Markets team. We're a small, lean, nonprofit organization. We don't have an event staff, or frankly, much staff at all. So everyone on the team did their usual jobs, and then on top of all of that, put together this conference. First and foremost, I have to thank Natalie Schatz, our Director of Administration. She has also become the Director of Logistics, Technology, Graphics, Layout, Design, Media, Speaker Relations, Photo Editor, Proofreader, and literally every other aspect of this conference. It would not have happened without her, and we are immensely grateful to her. Our Communication Director, Pam Russell, and our Senior Counsel, Jason Grimes, have worked tirelessly on all aspects of this event for many, many months. Jason, in particular, backed up by Cale Keeble, a friend of Better Markets, has labored over every aspect of the reports we released today, and I mean every aspect. Jeremy Bratt, our Director of External Affairs, and Michael Hughes, our Research and Program Assistant, were also invaluable in making so much of today happen. Our subject matter experts, Joe Suzuki, Tim Clark, Steve Hall, and Lev Bagramian, labored over the reports, making sure they were complete and accurate. And Ed Silverman, a senior fellow, provided helpful support, advice, and counsel throughout. Finally, Marianne Abdelmeshi, our Director of Development, provided critical support and assistance throughout the many months of planning and executing this event. Without their hard work and commitment, this event would not have happened. I'm immensely grateful for their work, not only on this event, but also for their daily dedication to the mission of Better Markets and their selfless commitment to the public interest. Now, before I hand it over to Jeremy, I want to say it has been a pleasure working with him and the entire George Washington Law School team. We are grateful for Dean Bracey's participation, and we look forward to the new dean, Dana Bowen Matthew, who will be arriving soon. As I said at the beginning, we have been honored to partner with GW over the last decade. We've always come away the better for it, and the events have always provided not just information, but insight and often inspiration. That comes from an impressive, dedicated administration and faculty and really smart, energized students. And Jeremy epitomizes the best of GW Law. In addition to teaching, he serves as the Director of Business and Finance Law Program and quietly goes about shaping minds, envisioning a better future, helping students achieve their potential, and then sending them off to make the world a better place. Jeremy, thank you for your partnership, your good cheer, and insights and hard work. It's been a pleasure working with you putting on this conference.
Well, thank you, Dennis. And let me first add my thanks to Dennis's, to all of the great speakers today who've given us much to think about and continue to work on. Beginning shortly after the signing of the Dodd-Frank Act in 2010 and continuing to 2015, GW Law School initiated a series of annual conferences examining various aspects of the Dodd-Frank Act, from the new derivatives regulations to the political economy of regulation, including the problem of regulatory capture mentioned by Sheila Bair, to the fate of the too big to fail phenomenon post-Dodd-Frank. In a number of these earlier events, Dennis Kelleher individually and sometimes Better Markets institutionally were valued partners. It's thus particularly fitting that we're able to commemorate the 10th anniversary of the signing of the Dodd-Frank Act in close partnership with Dennis and Better Markets again. So on behalf of GW Law School and Interim Dean Chris Bracey, who helped open the conference, and our Business and Finance Law Program that it's my honor to direct, my thanks to Dennis and the entire Better Markets team for their generous and professional collaboration. Of course, it's a great pleasure for me to thank our terrific GW Law team for their steadfast work on this, particularly Rennie Saula and Sarah Prabhakar of our Business and Finance Law Program, Nazir Nizamuddin and Matt Bokniak of our IT Department and Media Center, Liz Field, Kara Tershell, and Emily Branham of our Communications Department, and Alicia Garvin of the Dean's Office. Finally, many thanks to all of you in the audience for your sustained interest in this important subject. Thank you and good evening.